Good morning, everyone. It's 9 a.m. here in New York City and in Washington, D.C., too. This is Yahoo Finance Live. I'm Brad Smith alongside Rochelle Akufo. Here are three things that you need to know to start your morning. Not a great quarter for Best Buy, despite beating the street. The retailer lowering its sales outlook for the year after notable declines in mobile phones, consumer electronics, and appliances. Its revenue target now stands between $43.8 billion and $44.5 billion. It also foresees a further drop in comparable sales between 4.5% and 6%. So could this be the bottom, however? That's the big question. CEO Corey Berry saying that she expects this year will be the low point in tech demand. Let the negotiations begin. The Biden administration has unveiled the list of 10 prescription drugs that will be up for price haggling between drug makers and Medicare. The list includes Johnson & Johnson's Xarelto, used to prevent blood clotting, Merck's Januvia, which is used to lower blood sugar for those with type 2 diabetes, and Amgen's Enbrel, which is used to treat rheumatoid arthritis. Now, plans are controversial with drug makers, but are a key tenet of President Biden's Inflation Reduction Act. And Tropical Storm Idalia has strengthened into a hurricane as it turns towards Florida's Gulf Coast. It is set to make landfall in the Big Bend region, bringing with it 75-mile-an-hour winds and the threat of flash floods as well. So around 14 million Florida residents are currently under hurricane and tropical storm warnings. And it comes as FEMA announced nearly $3 billion in funding for communities to build resiliency against extreme weather fueled by climate change.
Well, Best Buy shares we're taking a look at this morning as its second quarter results beat expectations for revenue and earnings, and comparable sales coming in at a narrower loss than expected. But the outlook is the key here. The company updating its full-year guidance and lowering its revenue target to between $43.8 billion and $44.5 billion, as well as expecting a further drop in comparable sales between 4.5% and 6%. But they did raise their EPS guidance for the year. Now, Brad, obviously we're coming at the tail end of what we're seeing with some of the consumer discretionary spending companies here. This was considered sort of better than feared, but a lot of that softness that we saw in things like cell phones, appliances, home theater, mobile phones, and the CEO also noting some of the trade-off decisions that they're seeing customers making and still expecting that softness to continue as well.
Yeah, there were four key things that I kind of took away from this. One, they narrowed their guidance toward the lower end of the range there, kind of, bringing that range closer together, but towards the bottom end. So that not good. Forecasting electronic stabilization by next year as well, and that's going to be driven by replacement cycles. That was at least part of the expectation that was also discussed with regard to where they're seeing some bottoming out in the demand profile right now. And so from a merchandising perspective as well, one thing that did catch my attention was that the largest drivers of comparable sales declines on a weighted basis, it was appliance, it was home theater, it was computing, mobile phones. I mean, I kind of think back to Jason Kelsey's Eagles championship speech for the parade saying it's the whole team. Like that feels like everything. Appliances, home theater, computing, mobile phones. What's left out? Cameras, I guess. But ultimately, at the end of the day, they did give me for some camera products. But domestic online revenue, that was interesting too here. That decreased by about 7.1% on a comparable basis, which perhaps could give you an inkling or at least some type of thinking into how consumers want to get their hands on the product before they're making a purchase, which would further lead to the thought that they're being extremely scrutinous with how they are spending right now. And so that discretionary spending certainly hitting the doors at Best Buy and some of those aisles as well. And so what more they have to say on the call is going to be interesting to see if there's anything that kind of crosses the wires around that too, Rochelle.
It's true. I mean, and there were a few bright spots. I mean, when you look at product margin rates, those improved along with the financial performance from some of the company's membership offerings. So, and also we saw that domestic gross profit rate, that improved 110 basis points to 23.1% of sales. So some bright spots, but still really not seeing much certainty from the consumer. The CEO noting the financial results better than expected, but they reflect a consumer electronics industry that remains challenged, expecting this to be the low point in tech demand after 2 years of sales declines. So still seeing these trade-offs. And as we've noticed, some of these big ticket items consumers continuing to pull back from, saying maybe I'll wait for the Labor Day sales. Maybe I've bought everything I need to buy in terms of big ticket items when I have other expenses and student debt repayments coming on deck as well. But it's just not what they're prioritizing right now.
Yeah, I mean, I highly doubt if anybody is kind of going back to school right now and just waiting for a Labor Day sale to hit, that they're going to, skip their way into a Best Buy to try and pick up a big screen TV. However, I did have a roommate that bucked that trend in college. We won't go into his details, but one way or another, I think for a lot of the retailers that are trying to make sure that they're discounting where appropriate, especially given the volume pullback that they are seeing, that they're not sacrificing margins tremendously. But that is unfortunately the case that is playing out with a lot of the larger appliance or big ticket item retailers right now. I'll just kind of end with this quote here too, from Corey Berry saying, we continue to expect this year will be the low point in tech demand after 2 years of sales declines. Next year, the consumer electronics industry should see stabilization and possibly growth driven by natural upgrade and replacement cycles and normalization of tech innovation. Perhaps it's foldy phones. Maybe foldy phones will be all the rage, and I don't know. Maybe I'm still waiting for that roll-up television. We saw that at CES a couple years back, so maybe that will be the tech innovation that will make its way into some living rooms and dens and whatnot. We also got to talk about J.M. Smucker this morning, though, too. We're kind of pouring into these results. The company reporting mixed first quarter results, and they did see comparable net sales increase by 21%, driven by a 13% increase in volume, primarily thanks to, get this, Jif peanut butter. The snack foods company also raised its profit guidance for the full year, now expecting adjusted earnings per share between $9.45 and $9.85. Perhaps we can just pull up a quick look at JM Smucker shares once again to see how those shares are reacting here for our viewers. They're higher after this report, Rochelle, by about 3.2% right now.
And you raised some interesting points here. I mean, those comparable net sales you mentioned, Jif peanut butter. Got to admit, I'm not a peanut butter fan, but clearly millions of people out there are. Also saw contract manufacturing sales doing well, and then also tied to some of those divested pet food brands, because we know that there was some concern about how some of their pet food brands would do. And of course, also their coffee brands. You have to imagine Folgers also doing well for them. When people were sort of trading down, trying to save a few bucks maybe from that cup of Starbucks when they're trying to tighten their purse strings, Folgers brand has really done very well here as people have been trading down. And especially, people are trying to make some choices, but then you have to wonder some of the more expensive consumer food items like their jams or their jellies, whether or not people will be willing to trade down there as well. So that'll be an interesting conversation to have.
Yeah, and I know what people are thinking at home. What about the Uncrustables? Well, they did pretty good. Smucker's Uncrustable frozen sandwiches, as well as Jif peanut butter, they drove some of the volume mix net sales increase by 28 percentage points there. And then also they saw some higher net price realization, increasing net sales by 22 percentage points as well. So for all the Uncrustables fans out there, that's just a little nugget for you to snack on if you would like. We will be covering these results and more with Mark Smucker, JM Smucker Company CEO, at 11:45 a.m. Eastern. You do not want to miss that.
That's right. Well, the long-predicted recession has been kept at bay for now, thanks to a robust job market and resilient spending. But will the good times last? Well, while retail sales grew stronger than anticipated in July, several companies cautioned of a spending slowdown in their earnings outlooks for the year. Now, a new batch of data out this morning will give even more insight into where the consumer is headed. Today's JOLTS numbers out in less than an hour will be closely watched for any sign of a slowdown in openings ahead of Friday's jobs report. This week's series of key employment data will provide crucial insight into the strength of the labor market as the Fed debates their next rate hike move. So where will the consumer take the economy? Joining us now to discuss is Caleb Silver, Investorpedia's editor-in-chief. Good to see you, Caleb. So break this down for us in terms of how retail investors are looking at this environment right now.
Yeah, I think they're a little bit sketchy right now. We had such a good start to the year and then a pretty intense pullback. And there's this general fear on both sides, whether their fear of missing out or the fear that things have come too far too fast, especially in some sectors. So when we ask our audience, our readers, what would you do with an extra 10 grand? Most of them said they would try to buy extra stocks with it, but a lot of them are sticking to CDs and money market funds. Searches around best CDs, best high yield savings accounts, and best money markets accounts remain strong. They've been strong all year because investors are like, maybe I will take 4 or 5% until I really believe that the rally is going to be for real or will resume for real. So we've been watching that pretty closely right now. That said, we have a lot of individual investors who like putting money to work on Investopedia, and they're just waiting for the right moment to get back after it.
Caleb, we had a report from Best Buy this morning that we were just running through, and one of the takeaways was that the executives are hopeful that consumers will be more apt to continue purchasing should they see the right discount or should they see the right sale taking place. Is the data right now telling us that this is a consumer that is still gleeful to go into a Best Buy, to go into a Home Depot, and confident in making a purchase in a big ticket item as long as it's on sale?
I think that has a lot to do with it. That said, I think we're at the tail end of that revenge spending coming out of the pandemic now, a year or so removed from the fact that we can go out and do whatever we want. So you saw that shift from first we had goods, and then we had a lot of spending in services, a lot of spending in travel, people going to see folks, people taking big trips, the experience economy. And I think right now people may be tapped out. And then Rochelle mentioned it, we do have the resumption of student loan payments coming up here in about a month. That should take a pretty big toll on spending for about 40 million Americans.
And Caleb, are we getting some clarity into what people are spending on sort of within services? How are they still willing to put that money to work? Even though, as we're looking at credit card debt mounting, they're clearly not able to sort of balance that budget right now.
Yeah, well, travel was very big this summer. We did see that spike in gas prices over the last month or so. I think a lot of people put money into that. But I think people have also been spending in and around their home and their home experience, trying to get that ready for the fall, for the back to school season. So consumers, again, feeling a little bit tapped out here. Investors, again, on the fence, should they stay or should they go? It's kind of a clash moment for a lot of investors, wondering which direction the market's going to go and if momentum is going to be there. You know, the stock market, when the stock market has such a strong first half of the year like we had, it produces what we call the wealth effect. It makes people feel wealthier because they're watching shows like this, they're seeing the averages move higher, and then when you get this pullback, you get this feeling of, oh, are we about to have another moment like we had back in 2020, or like we had last year, or like we had in 1999? So there's still a lot of psychological damage from those crashes.
I think we all look at charts like the one that was just up and think about what that credit card spending leads to in terms of long-term debt, and what broader implications that has on the economy and the consumer even further out from here, because that's something that's been cited in terms of the delinquency rates that are now rising from many of the retail CEOs over the course of this earnings period too. How concerned should they be about those delinquency rates and the long-term ramifications?
Yeah, well, right now they're pretty small, though they are growing. We're seeing a higher trend. The Fed noted it in its report recently about the record credit card debt. So that's starting to boil up. And you know, that hurts lower income folks the most because they can't avoid the big spend at the grocery store. They can't avoid filling up their car with gas and shelter. Those are the three things that are costing the most right now: food away from home, shelter, and gasoline prices. So they can't avoid that. That hurts that lower income consumer the most. The higher income consumer is doing okay as long as they're employed, and we have seen wage growth at 4.5%. So that's buffering some of that a little bit, but I think we're going to see the slowdown first in the lower income and then move its way a little bit higher.
And obviously, a lot of these retailers still want to be attractive to some people who are, trying to be a bit more budget conscious. How do they walk that fine line between not discounting so much that it affects their margins versus still being able to attract all these consumers and try and scoop up those dollars?
Yeah, look at the retail earnings we've seen so far. Target obviously not performing very well right now because people are being a little bit more cost conscious. And then you look at Walmart, which had a much stronger quarter, but Walmart has a lot more broader offerings. They have the groceries, they also have the goods, and they also stack them high and let them fly. They're willing to discount at scale because they have enough sales volume to handle it. But some of these other retailers, there's a point at which it really hurts their margins too much to keep discounting. And if the consumer doesn't feel strong enough to make purchases, then discounting doesn't really make a lot of sense. But take it outside the retail sector for a second and look at a company like Tesla that's done intense discounting to move volumes. That's actually worked for the company because it continues to grow market share, even though it's cut way into its profit margins.
And that's about the equivalent of higher the inventory in the aisles, the closer to God. We'll workshop and see how that goes over for some of the retail watchers out there. Just while we're on this topic, though, too, as we look through what's taken place over the course of back to school season and then try to layer on to what that means for Labor Day, and then even further on into the seasons, then we get into holiday shopping season. Is there anything foretelling about what back to school season has seen that we can extrapolate and apply to the holiday period as well?
Yeah. Well, when you look at the back to school items that we've been buying, a lot of things are more expensive this year than they were last year due to inflation, but we have seen drops in meaningful areas. Cell phones is one of them, right? Cell phone plans actually cheaper than they were last year. That said, musical instruments, clothing, especially clothing for women and girls, that's more expensive this year. So we have seen people buying the necessities and getting ready for the back to school season, but I'll bet you both that we're going to see that holiday shopping, that Christmas shopping season start even earlier this year than it did last year. They keep rolling it back. I bet you by October we're going to start to see some of that come up.
I mean, look, the more and more pumpkin spice latte season continues to get pulled forward, everything else, so too goes with it. Just lastly, while we're kind of on this topic and kind of rounding out the consumer, it comes back to wages. It comes back to what they're making. And particularly here, even as we're looking through where those opportunities are, we're kind of evaluating the JOLTS report that's just come out as well and trying to figure out as we're leading up to the monthly jobs report, what for that month-over-month wage movement, how the consumer is thinking about where they're able to still put their wages to work and how they feel about their spending too.
Yeah, as long as the wage growth remains in areas, in the middle to lower income jobs, that's going to be strong. Higher income folks are doing just fine. They can handle it. But as long as we continue to see wage increases, again, in those $75,000 to $120,000 jobs, you'll probably see some stabilization in spending right now. But we have to watch that pretty closely. You are seeing a really strong labor movement this year, obviously, with UPS. They got a nice raise. UAW's workers have authorized a strike on the big three automakers. If they get wage increases, that could be meaningful as well. That would go out again 4 years. But the psychological impact of workers being able to get more from their companies, that's very important right now. And as long as we don't see steep job losses, you'll see some confidence in spending. The consumer's going to remain pretty confident. But if all of a sudden we start to see big layoffs happening, if we start to see the private sector, we'll see those ADP private payroll report on Thursday. If we see that starting to show some slack, that could be troubling.
All right, Caleb, stay with us. We've got much more to discuss here this morning. We've got to talk about Nvidia because it's a day that ends in Y. To say Nvidia's stock is on fire is an understatement. Take a look at this year-to-date chart. Shares are up more than 220% as the AI hype train keeps pushing markets forward. Investors certainly feeling optimistic as they pour more money into the tech companies riding the AI wave. But just how long can their enthusiasm drive this rally? Caleb Silver, Investopedia editor-in-chief, is still here with us. So, Caleb, you've been tracking as well something that some viewers may not know about or have heard about called a Minsky moment. But is the Minsky moment showing any signs of rearing its head in the AI trade right now?
Yeah, the Minsky moment is not a painful dental procedure even though it sounds like one. It is a moment that investors worry about where something happens and all of a sudden we get into this spiraling market crash. And I don't think we've seen that. We've seen a nice, healthy pullback after a really strong rally. So that Minsky moment is something investors have been looking up on Investopedia lately, one of our top spiking terms, because they're worried we might be at the brink of something. Well, there's really nothing to suggest that we are except that psychological scar tissue of the fact that we've had two bear markets in the past 2.5 years. It's rare that they come that close together. Of course, 2020 was COVID-induced. So there is a concern about that. When we think about AI, the big question is all the hype priced into these stocks? You take a look at a stock like Nvidia, and you have to wonder, that's a pretty healthy price to sales ratio, and healthy, but I mean very big.
Right.
But Nvidia's got a lot going for it. It doesn't just surround itself in the AI ecosystem. It's making chips for gaming, it's making chips for servers and for cloud storage. So Nvidia has sort of that full package. You mentioned a good playoff team, full balance across the squad down the bench. Nvidia has that going on. Some of the other stocks that are AI adjacent may have gotten that pump just like we saw with crypto a few years ago, just like we saw with cannabis a few years ago. Everybody dropping AI into their name, into their earnings reports, not necessarily there, but liking to be around the aura of it. Is it priced in? Well, we've seen a big sell-off in AI-related stocks lately, absent Nvidia, which just keeps crushing it seems, week after week, day after day. So some of the air may have been let out of the AI bubble a little bit, and we're going to see which companies remain that have the most strength in that area and can use it to enhance their businesses and their profitability.
So Caleb, I want to dig into some of the other terms that are being searched on your website other than Minsky moment. What else are investors looking for right now?
Well, as I mentioned, they're always looking lately, especially this year, for the top CD rates, the top money market funds. Where can they put their money that feels safe if they're uncertain about the stock market right now? Also, folks looking into different ETFs that they can play to take advantage of maybe the recent dip in the stock market. So we're always tracking what they're watching, and for us, it's a way to measure their anxiety. When people are really anxious about the markets and the economy, they start looking upwards like Minsky moment. They start looking upwards like correction, like bear market. We've seen a little bit of that lately, as that we've seen that little bit of a sell-off, but in general, it's a lot of people looking for where to keep their money safe so they don't lose to inflation or they don't lose their principal while they wait and see if the stock market has another leg up to end the year. And the year after a bear market is very strong. Typically, historically, we had a good first half of the year. We'll see if this is just a healthy pullback, and then we resume to the upside, because the year after a bear market like the one we've had, the stock market usually goes up somewhere between 20 and 30% on average.
There was a lot of healthy conversation yesterday morning with some of our guests about where investor sentiment stands going into an election year. I mean, we're just a couple weeks away from it being the fourth quarter of 2023, which means that's going to commence all of the conversation around who's running for presidency, who's running for re-election perhaps, what are the campaign policies that are being talked about on the trails here, and all of those very much an economic consideration that the markets are also going to react on too. So what is the vibe of investors even ahead of Q4 now, which is going to be the last quarter prior to another general election year, which some CEOs and some top executives have expected to be very vitriolic? Yeah,
so we do a bi-monthly survey of our newsletter readers, about 1.5 million readers for our daily newsletters. We do a bi-monthly survey and we ask them what their biggest concern is. And it is not the upcoming election next year. It is inflation. It is high interest rates right now. It is uncertainty around China that they're more concerned about than who's going to be in the White House. And we always make a big deal about the election and who's going to be in the White House. Investors prefer gridlock. So as long as we have gridlock and they know there's not going to be a lot of policy change, that's probably going to be a positive for the market. But if it looks like a Republican sweep, potentially, then you could see potential tax cuts, the return of those tax cuts coming back. That could be very good news for the market. But right now, investors are more concerned about what's facing them. And what's facing them? Continued high prices, higher for longer interest rates, a hawkish Fed that is still waiting to get down to that 2% target. That, I think, weighs more on investors' minds, and they're looking at those options. If you're uncertain about the stock market, what do? You put money in the bank, because the bank is finally giving you money, and they've been doing pretty well just keeping their money on the sidelines. There's $5.5 trillion in money market funds right now. That is a lot of dry powder waiting for the stock market to show some signs of rebounding again going into the fourth quarter of the year.
And Caleb, in terms of risks that you think retail investors might be missing or perhaps overreacting to, what is really standing out to you?
Well, I think some of the risks out there are the ones that are pretty obvious. Have we come too far too fast? Are we going to have another spike in Treasury yields? You know, that does a pretty big number on high-priced stocks. We've seen those valuations come down. I think there's some of that. I think China, what's going on in China is a big mystery. It's our biggest customer here in the U.S., and the Chinese stock market and the Chinese economy, they are mysterious to say the least. So on the one hand, it drives investors back to U.S. markets, and you've seen U.S. markets again start to outperform again. On the other hand, if the unraveling of the real estate sector in China continues with Evergrande and other potential banks and real estate companies, there's a lot of contagion. And contagion is also one of the top search terms on our site, because investors are wondering, how bad could it get over there? And will that impact us back here in our portfolios? So some of the biggest banks in the United States and around the world have underwritten loans in Chinese real estate. We don't know how bad it is, because we'll never know how bad it is over there. But I think there's a worry that things could get even worse, and we could have a moment where we start to see a big unraveling that impacts the banking sector here, and that starts to roll over into other sectors.
And you raise a good point about the mystery. Obviously, some of that data, we're not ever sure how accurate that is. So certainly important to keep in mind when we think of the banks that have invested over there. A big thank you to Caleb Silver, Investorpedia's editor-in-chief. Thank you for your time this morning. Well, this morning, the Biden administration named 10 prescription drugs up for price negotiations, kicking off a program aiming to reduce costs of Medicare's most expensive medications. Yahoo Finance's Anjali Kemlani joins us now with the latest. I know this is going to be an incredible list that people are going to be keeping an eye on.
That's right, Rochelle. And it's safe to say that this is the equivalent of the NFL draft picks for the drug industry. Really a lot of energy and assumptions that have been made in the last few months, but let's get right to that list. Topping the list, Eliquis from Bristol Myers Squibb. That was the top pick, as well as Jardiance from Boehringer Ingelheim and Eli Lilly, Xarelto from Bayer, a couple of Merck drugs, AstraZeneca, Johnson & Johnson, Novo Nordisk, all of these companies really making the list, and really interesting to see how they kind of fall into some of the categories of heart disease, diabetes, as well as some autoimmune diseases. But the last two on that list, specifically Stelara from Johnson & Johnson and the insulins from Novo Nordisk, took some by surprise, not expected, as they are either going to be facing biosimilar or generic competition, which is basically one of the exclusion factors from the Inflation Reduction Act. And then insulin's already priced at about $35. That out-of-pocket cap has already been set in, but because there's different types of insulin, these did make the list. So it's really interesting, and we're going to have to see whether or not there is any room or wiggle room if this list ever changes. We do know that these accounted for about $50 billion in spend from June of 2022 through May of this year, or about 20% of Medicare Part D spend, according to CMS. And that is where the focus has been, these high spending drugs, out-of-pocket costs as well, about $3.4 billion in out-of-pocket spend for some of these members. So, obviously targeting those drugs for those reasons. We do know that a number of these companies have already filed lawsuits against the health department as well as Medicare, and are hoping to either slow down the process or stop it altogether. There have been multiple lawsuits in multiple districts, which some experts say could be a way to fast track it to the Supreme Court. So certainly going to see whether or not they are successful in doing so. But as of right now, these are the drugs that will make it to the list for 2026 negotiated prices.
And Anjali, when we think about what types of savings households will be able to see as a result of this, what type of impact are we talking?
That's right. That's where the out-of-pocket number comes in, $3.4 billion in total in out-of-pocket spend. So that's where the impact comes from. Some of these members have been spending that much and even more. Some of the drugs cost out-of-pocket more than $6,000, whereas in some are in the hundreds of range. So similar to what you see in the commercial market, but of course, these are supposed to be largely covered drugs and supposed to have, that kind of protection. And so that's where the U.S. government is looking to really cut costs. In previous years, there have been a lot of discussion about whether or not Medicare has been billed too high for some of these drugs. And of course, we also know the discussion around the U.S. in general paying for too much. So certainly savings in the works. And it's really hard to tell exactly how much will be saved right now. But as of the information from the administration, that out-of-pocket spend is really what they're targeting.
And as we know, some drug makers are refusing to negotiate with Medicare. Some are saying, look, if we try and cut these costs, it means we can't invest in future innovation. Talk about some of the reaction that we've had from some of the drug makers here.
That's right. It's exactly what they've said, Rochelle. They've said that they are going to reduce innovation. It's going to affect whether or not they decide to acquire certain drugs as part of their M&A strategies. We've also heard from AstraZeneca, for example, that they've already put in place some measures to restrict, and they're one of the companies already suing the administration. So there are threats that it will, either reduce their strategies, reduce their research and development, or others are saying that it could in fact negatively impact seniors depending on how they, depending on how they decide on those costs, where those costs go. We know that for the longest time, the drug industry has talked about costs, and the health industry in general has talked about costs like a balloon. Squeeze one side, it goes to the other. And so that's definitely something we have to wait and see how they participate, whether or not they're willing to take on the fines, whether or not they're willing to go through with the negotiations. And also something to keep an eye on is also the potential biosimilar and generic drug competition in the future. But all of this, I know we all know that we're going to be hearing from CMS Medicare head Dr. Meena Seshamani soon, so we'll definitely get more answers soon.
Certainly important stuff there, and looking forward to that conversation. A big thank you there to our very own Anjali Kamlani. You won't want to miss that conversation. All right, we have the opening bell on Wall Street. Let's do a quick check of the markets at the moment. Taking a look at some of the futures right now as we wait for the boards to kick in there. Futures were in negative territory. And there you go. There is your opening bell for today, August 29th. And let's take a look at how we're opening right now. A mixed picture here. The Dow in slightly negative territory, but relatively flat, down about 6 points. The S&P 500 there also flat to start the day. And the tech-heavy Nasdaq there, the strongest gainer so far, up 114 points or 0.9% roughly. So, Brad, what else are you seeing at the moment?
Yeah, I'm going to pull this out to a 1 month view for our viewers. So as we kind of end this month of August, they can really get a view of what's taken place here for the Dow over the past 30 days, which of course takes us just a smidge, technical term there, back into July. We are down by about 2.5% over that 30-day marker. But here today, out the gate, flat just barely to the upside there. Take a look at the Nasdaq Composite here right now, though. That is down for the day by about 8 points. Of course, we are early in today's trading session. We've just struck the first full minute of the session, so we'll keep a close eye on that. A lot of runway left there, but taking a look at the Nasdaq Composite over the month, that's down by about 4.3%. And you can see where a lot of that move has taken place over the month of August and trying to rebound off of some of those August lows as well here. We'll see what more fervor tech investors can do in terms of driving the markets as of right now. But for the S&P 500, you're also seeing that down over the past 30 days by about 3.3%, flat just barely to the downside to begin today. So some marginal moves lower here for the major averages here in the U.S. Also want to take a look at the S&P 500 sector activity as we begin today's trading session. Taking a look at the sectors, and this is a month-to-date view, so let's put you on intraday because I might have just scared a few folks at home. XLK, that is bringing up the caboose. That's down by about 0.3% here, and we're mixed. That means we've got a little bit of green on the screen at least. Communication services, you're seeing that higher by about 0.3%, and particularly could be driven by some of those telecommunications companies as well here, as we're going to dive into that in just a little bit. So about as split as you can get out of 11 sectors. It looks like we've got 5 advancers right now and 6 laggards. And then also taking a look at the Nasdaq 100, you've got a lot of red on the screen here. Just to give you a full glimpse of this heat map, bringing up the caboose. A company we don't talk about all the time, PACCAR, right now, that's down by about 2.8%. Lucid, though, that's down 1.3%. We talk about them quite a fair bit. And then leading the charge right now, you've got Pinduoduo, that's up 11%. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Are high rates going to be a headwind for growth stocks? They were earlier in the year. They seem to have been less so more recently.
In theory, yes. In theory, high rates should be a headwind for growth stocks and value stocks to some extent too. But that divergence can persist for some time. And so if investors would rather focus on the sizzle than the steak, so to speak, then they don't become a headwind until it's really problematic.
The Biden administration released a list of 10 prescription drugs up for price negotiations this morning, a major step forward in the decades-long push to lower drug prices. Now let's head over to Yahoo Finance's Anjali Kamlani. Anjali?
That's right, Rochelle. And we know that, of course, it has been a list that has been eagerly anticipated, and here to discuss all of it with me is Dr. Meena Seshamani, head of Medicare. Dr. Seshamani, really a really active morning for you, I'm sure. A lot going on in the discussions around what happens next and the drugs that were in fact selected. So let's start off with the what happens next. You have a little bit of a breather between now and when negotiations start. Talk to us about what's going to happen. What are the next steps?
Absolutely, and thanks for having me, Anjali. So today we released the 10 drugs that have been selected for negotiation. The next step is on October 1st. The manufacturers can decide whether they want to participate in the negotiation process. October 2nd is when we will get data that we will use for this negotiation. We will then engage, have patient-focused listening sessions for each of the 10 drugs, meet with each of the manufacturers, and then enter the negotiation process with an initial offer. All of this is laid out in the Inflation Reduction Act law and in the guidance that we put out. So on February 1st, we will put out our initial offer to the manufacturers. According to the Inflation Reduction Act law, they have about 30 days to provide a counter offer if they do not agree with that offer, or to accept that initial offer. If with the counter offer that CMS doesn't agree, then we will engage in up to 3 negotiation meetings for that back and forth, ultimately leading to a final agreed maximum fair price that will be published on September 1st, 2024. And we will also then subsequently publish a narrative about that entire negotiation process.
I know that some of the companies have already filed suit trying to delay or stop the process altogether. And in their lawsuits, some have said that they're worried about what that maximum fair price is going to be and that it could, quote, be as low as a penny. And so I wonder what your thoughts are on that and how, if you could explain how Medicare is going about deciding what the bar is for an appropriate cost.
Yes, I think we all have shared goals that we want to improve access and affordability for the innovative therapies that people need. And as we laid out in our negotiation guidance, we want to be able to look at the benefits that a drug brings to populations. Does it address an unmet need? Does it address different populations that have needs? Can we look at things like being able to live at home and not be hospitalized, and to be able to incorporate all of that into an agreed upon fair price for the Medicare program for all of the people who rely on these often life-saving medications and for the American taxpayer. And so that is how we will approach this in a true back and forth negotiation process.
I know some of the drugs that were listed caught some by surprise. Some expected, like Eliquis, but then Stelara, I know a couple of reporters have already asked about the fact that they may be facing generic competition, as well as the insulin because of that out-of-pocket cap already in place. Can you explain why some of these drugs made it and whether or not the list could potentially change before 2026?
The list of drugs that have been selected will not change. Those are the selected drugs. How we came to that selection was following the new drug law, what is written in the law, where first we looked at the 7,500 drugs that are covered in the Part D Medicare program and looked at which ones are what are called in the law qualifying single source drugs, meaning that they are drugs that have been on the market for 7 years for a drug product, 11 years for a biological product, and do not have competition. From there, again, following what is in the law, we excluded drugs with low Medicare spend, plasma-derived products, certain orphan drugs. We also got information from manufacturers for a small biotech exemption. Again, that is laid out in the law. And then also looked at whether for biosimilar manufacturers, they could submit a request to us for a potential delay if there's a biosimilar coming on the market. Again, that is laid out in the law, and all of this is also put in detail in the guidance that we put out. Once we went through all of these criteria, we ranked and basically have the top 10 drugs in highest gross spend. So all of the drugs that are listed are ones that met all of those criteria.
Now, tell me about these companies that were selected. I know that, the administration chose to release this list before the opening bell, and it hasn't really seemed to make an impact on the stocks right now. Do you see that as a sign that they are not really going to be impacted negatively by these negotiations?
Well, I think we know that the pharmaceutical industry is strong and thriving, and innovates and will continue to innovate. And in fact, the way that we have laid out, as we were talking about, Anjali, this negotiation process, it really is with an eye towards how do we reward the innovations for the cures and therapies that people need? How can we incorporate real world evidence for these drugs that have been out there being utilized to understand what impact they have in the real world for real people, so that we can take that into consideration as we look at what a price should be for these kinds of medications. And I think that's what you're seeing.
And I know that the fines are going to be put in place for those companies that decide not to participate or who don't want to participate in the negotiation process. What then happens with this list, and what happens to those companies? Is it, a fine in perpetuity, or is there an end point?
Yeah, so there is an excise tax that is operated by the Treasury Department, by the IRS. If a company decides not to participate, in the negotiation process, as you described, we laid out in the guidance where, if there are ways that a company cannot have that excise tax, where they can, negotiate and come to an agreed upon maximum fair price, or they can exit the Medicare and Medicaid market. And the details of that are in the guidance. In terms of the drugs, if a company does decide to come back and participate in the negotiation process, we have laid out in our guidance that we will engage, we will, use the same process that we are laying out now if a company comes back at a later point. And also in the guidance, we lay out that we will continue to monitor for competition for these drugs. There are ways in which, again, laid out in the law and in our guidance, where a drug that is selected may not have the negotiation if they meet certain criteria that have been laid out.
Well, certainly leaving that open door policy, as companies are familiar with, we'll have to leave it there, but certainly a lot more work for you yet to do. Dr. Meena Seshamani, head of Medicare, thank you so much for joining us today.
Thank you for having me.
And our thanks to our own Anjali Kamlani for bringing us that conversation. Excellent stuff there. Switching gears here, Chinese EV startup NIO trading to the downside this morning after a worse than expected second quarter report. The adjusted loss of 45 cents a share was steeper than the street expected. An upbeat outlook for the current, however, offers investors something to cheer, but they're not really doing much cheering right now, Rochelle.
That's right, Brad. Meanwhile, a different story for China's EV market leader, BYD. Record deliveries sent second quarter profits surging 145%. Net income more than doubled to 6.8 billion yuan for the period. The report comes amid an ongoing price war, with Tesla trying to keep pace with rivals. You see there the stock up more than 1.5% this morning. It's an interesting picture when we look at China's EV space, because they do have that pricing power, which is why we do tend to keep seeing Tesla bringing some of those prices down, much of the chagrin of the margins here. But even as we look at what's been happening with NIO, I mean, Q2 deliveries disappointing, seeing a consumer shift from SUVs to sedans. So you also have the pricing mix, and then you have the changing consumer trends as well to consider.
Yeah, spot on. And, looking at BYD's number on the other side of this, you think about some of the margins that they saw. Margins improved year over year. Gross profit, at least. Gross profit margins were 13.5%. This same period last year, it was about 12.8%. Also, you basically saw the sales growth, particularly there in that region, move higher by 66%. That is significant. Of course, you got to think back to what the base is here, as the company is continuing to make sure that they can deliver on passenger vehicles and produce vehicles as well. They did deliver 1.2 million passenger vehicles and about 642,000 battery electric vehicles. From a year earlier, that represents a move higher of more than 90%, about 95% for the passenger vehicles. So that particularly getting some notice from the street here. You're seeing shares be rewarded there. That's up by about 4%. And then just going back over to NIO, not to be confused with the 2000s R&B singer, you're seeing deliveries actually quarter over quarter, just a little bit there. And particularly here, you look from Q1 where they saw about 31,000 deliveries take place. This most recent quarter, only about 23,520 deliveries took place. However, the deliveries, as we're kind of continuing to watch them in tandem with sales, the vehicle sales converted to US dollars, $990.9 million in the second quarter of 2023. That represents a decrease of about 24.9% from the second quarter of last year, Rochelle.
We certainly know BYD, a favorite there for Berkshire Hathaway. Well, we're also going to shift gears here. Now looking at shares in telecoms giants AT&T and Verizon, both of those pushing higher today after an upgrade from Citi. Marco Rollins upgrading both to a buy, saying their current trajectory makes it easier for both companies to maintain their high dividend yields. AT&T and Verizon both recently introduced targeted price increases for existing customers. Now, we know it's always hard to see just how much some of these companies can raise these prices, what that breaking point is for consumers. But at least for now, AT&T and Verizon seem to be well positioned, according to analysts, for a lot of these consumers to still stick with these brands despite the price increases. It's
particularly interesting, especially as you mentioned, price increases that are being passed through to consumers, where we are continuing to monitor what these companies, even in this kind of broader realm of where delinquency rates might be increasing, how that's impacting AT&T, Verizon, what they're seeing in the payments that are coming forward from their customers. And we've had the opportunity to have the CFO of AT&T on and speaking with us and giving a lot of transparency around that very metric. The Chief Financial Officer, Pascal Desroches, has told us time and time again and given us some insight into where those delinquency rates are moderating. But I think that's something to pay close attention to for investors here, as you're kind of getting a sense of where the consumer is maybe not breaking, but certainly bending, as JP Morgan's Jordan Jackson once told us, is showing up a little bit in the evidential data as of right now, Rochelle. So that particularly one area to keep close attention on. At the same time, while AT&T, Verizon investing, as well as T-Mobile, in the band spectrum that they deliver and that service and latency that so many consumers expect as well.
It's true. I mean, and you have to wonder perhaps when we go into the next quarter, how much more we're going to see some of this penny pinching start to show up as people, are looking at, which telecom companies they want to be with to save a few bucks, which streaming services they're willing to cut off. There's a lot of decisions that consumers are making. And as you mentioned there, we might see that start showing up perhaps in future quarters when people have some tough decisions to make at the moment.
Yeah, I might be a Wi-Fi siphoner at some point if I can't continue to pay these prices. We also got to talk about Big Lots. Shares of discount retailer Big Lots rocketing after a narrower than expected loss of $3.24 per share. Revenue landing ahead of expectations at $1.14 billion. Despite this, the company's CEO says the results illustrate a challenging environment in which the core lower-income customer remains under significant pressure. This is exactly what we were talking about earlier on the show with Caleb Silver about the lower-income customer being under pressure, looking for more discounts. But for Big Lots shares moving higher, as we saw here today by about 23% and really kind of driving that 3-month chart as of right now, too.
And it's interesting because, I mean, going into earnings season, expectations were already low. So when you sort of have these, better losses than feared narratives still coming, it doesn't give you a lot of confidence. And then even when we've been talking about big lots, a lot of people, aren't always 100% joyous. They're not top of mind when it comes to your go-to retailer, when you have the convenience of an Amazon for your purchases and other places. So it'll be interesting to see how they carve out more market share as we continue to see different consumers trending. And obviously we have back to school shopping and things like that, and holiday shopping coming up. People looking for the big discounts. I mean, I was looking online. They have massive discounts right now at Big Lots, but it all depends on whether it's top of mind for consumers and then how that ends up affecting the margins as well.
I'm just looking through the quote from Bruce Thorn, President and CEO, on the back of this earnings result, saying the consumer environment will likely remain challenging and result in negative comp sales in the back half of the year, but they're now in position to get back to playing offense. Of course, liquidity. That comes into focus too. He did have a comment on that, saying that they're actually very comfortable with their liquidity position coming into the second half of the year, strengthening their balance sheet. But you got to wonder, for the consumer pressures that are continuing, what more the management team will have to do in terms of inventory management, also in just how they're engaging with the consumer. But again, I mean, coming off of these results, I got to wonder what investors are really leaning into here. But a category mix that anybody who's walked into a Big Lots store, they can get anything from some snacks and candies all the way to, a piece of discount furniture. So we'll see exactly where and which aisles they gravitate towards. We got to leave things there for right now, but we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Do you think that Nvidia is a contributor to inflation?
That's a great question. I hadn't thought about that one. Perhaps because I think there are some companies clamoring for their chips. It's clear from their results that people really want them, and it seems that companies are paying up for them. So perhaps it's tough. It's probably not at the consumer level, but probably somewhere in the PPI it's buried.
Welcome back, everyone. Let's get on over to the New York Stock Exchange and take a look at the world's biggest cryptocurrency. Trading volume slumping to a 4-year low. Who better to explain why this is happening than Yahoo Finance's Professor-in-Chief, Jared Blickery. Hey, Jared.
New one, I appreciate that, Brad. I was just looking at the news flow around Bitcoin, and I think this describes and kind of illustrates why we have this lull in the action. I see a lot of stories about creditors in recoveries, Sam Bankman-Fried's proposed expert witness. I see the SEC issuing its first enforcement action targeting NFTs, and a crypto president. Top US 2024 contenders are not fans, and rivals are way behind. That's just not going to get me interested in crypto right now. Let's take a look at the charts and kind of take a look at what's happening. You can see that most of the days we'll see like 4 or 5 really low volatility days. That's these really small candles. Then we'll see a green one and a red one kind of pick up, usually going in the wrong direction. And then you have these big outsized moves to the downside. And to be fair, we've seen those moves to the upside too. We saw those earlier in June when it looked like we are on our way to clear 30,000 in a meaningful way for the first time, but it's just kind of more of the same. And you got to ask yourself, what's going to get investors interested in the crypto space? You take a look at what's happening in stocks overall. August, we've seen stocks slump. We've seen meme stocks. We've seen the fringier stocks give back a lot of their gains that they made in the prior months. And so the overall environment for something like crypto right now, with the decimation, obliteration that it's seen over the last year and a half, I just don't think we can expect that. It's going to take a little bit more time for the crypto spring, perhaps, to get its footing. And in that regard, we have a halving next year. That's a critical time when the amount of Bitcoin payments, rewards for people who mine Bitcoin, those actually are halved, and that causes more demand, creates less supply, and so that's a natural bullish statement, but that's next year. In the meantime, we still had incredible institutional involvement and investments in Bitcoin. I don't think that was for nothing. I think Wall Street is just gearing up for the next wave of interest. We just haven't seen that yet. So I think more of the same here, probably more of these low volatility days than not, until we get a major change in either interest rate policy, which really creates an upswing for all risky and fringy assets, or we get that happening next year. So it's going to be a little bit of time, I think.
It's true. Everyone always waiting for that breakout event. Hasn't quite happened yet, especially for some of the estimations that analysts have put out there on the more bullish side. Always great to get your take. Our very own Jared Blickery there for us. All right, well, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
So you guys tend to see things through a value lens. Sort of give us the status of value investing in this market right now.
The status of value right now is it's fairly still untrusted, disbelieved, and most investors are not enthusiastic about that. So we love that place because you can make great money proving people wrong in this business because what we're paying, we just think is far less than what everybody else is paying. And we're just buying different assets.
July's JOLTS data is in. We're taking a look at the numbers here. 8.827 million coming in versus 9.582 from the previous month, and about 9.5 million that was estimated before. As we take a look at also the number of hires and total separations, which includes whether you get laid off or quit or fired, that came in at 5.5 million for separations there, 5.8 million for hires. So, I mean, this is certainly edging down from July. Not sure if this will be enough for the Fed to make any changes, at least at its September meeting. Brad, what are your thoughts?
Yeah, just to put a little bit more color and context on this, on the final business day of July, this report also saying that the job openings edging down to 8.8 million of the areas where there was the largest impact, and this was an overall move lower by about 338,000. The rate was a little changed to 5.3% of job openings, but they decreased in professional and business services by 198,000. Healthcare and social assistance, you saw that move lower by 130,000. State and local government, excluding education, that was down 67,000. And then local government education also down 62,000. However, the increases in job openings, that came in information, that was up 101,000. And then in transportation, warehousing, utilities, that was up as well by about 75,000. So we were just taking a look at the futures to see if there's any reaction here on the day. Of course, out of the gate, we were flat just barely to the downside for many of the U.S. major averages. As of right now, you're seeing fractional gains. And for about 33 minutes into the trading session, for us to be holding on to these gains as well, perhaps investors paying closer attention to where the Fed might lean into, or at least look somewhat at the trend that's being made here. But the Dow right now is up by about 0.3%, S&P 500 up by about 0.5%. We'll round that off too. And the Nasdaq Composite holding on to gains of 0.7%. So a lot to really kind of chew on within this report. But as you mentioned, Rochelle, unlikely that, for this report that is one of the most lagging of reports and data that the Fed can look to, that it's unlikely to make any severe change in at least the tenor that we heard last week out at Jackson Hole.
And it certainly is a piece of the puzzle. Obviously, we're going to get a lot of jobs data coming out this week. We've got ADP payrolls. We're also going to get GDP data coming out, pending home sales, core PCE, of course, coming out on Thursday. So it's a lot to try and piece it all together before we even get the jobs report on Friday as well. And for people who are wondering, why does the JOLTS data matter? Well, it really gives us an idea of the churn, the ease of which people are able to flow from one job to another. It lets us know how people are losing their jobs, whether they're quitting or being laid off. And so it gives us a bit more detail than we would usually get from the jobs report, which is obviously the superstar of when it comes to jobs report data. But JOLTS is an important one to also hone in on, Brad.
Yeah, you mentioned the quits as well, Rochelle. Just to put a little color on that with the time that we do have left here. The number of quits did decrease by about 253,000, and looking further into the areas where you did see that rate, little change at 2.3%. Quits declined in accommodation and food services. That was down 166,000. Also, wholesale trade, arts, entertainment, and recreation, both of those areas also led some of the decreases in the number of quits. However, they increased in state and local government education. So we got to pay teachers better. And that is the soapbox that I will end on here for this JOLTS data. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What could higher rates mean for people's portfolios?
So higher rates, a couple of things. So if you're looking at your fixed income portfolio, obviously an ability to earn higher coupon, especially on very high quality parts of the market, earning close to 5% on something like 2-year treasuries, close to 6% on investment grade credit. I think that's an incredible opportunity for those savers. I think higher rates on your equity portfolio also has meaningful implications. So sort of navigating away from areas in the market that have historically been been expensive or been non-profitable, that have relied upon negative real rates. So positive real rates is probably going to be more beneficial for areas that of the equity market that are more profitable to begin with. So looking at quality in a portfolio makes a lot of sense. And lastly, I would say that higher rates and how long rates stay high is going to be pretty meaningful for just the consumption backdrop. So how you and I spend our money.
Right.
So thinking about the ramifications of that on the economy, not today, but perhaps in a couple of quarters from now, and what that might do to growth, which of course will have ramifications on equities, fixed income, and commodities.
It's just after 10 a.m. in New York City and Washington, D.C. This is Yahoo Finance Live. I'm Rochelle Akufo alongside Brad Smith. We're just over 30 minutes into the trading day, so let's take a look at how the stocks are moving there. We're seeing stocks higher on this packed day today. JOLTS edged down in July. Job openings coming in at 8.8 million as the labor market seems to be cooling slightly in the rising rate environment. We also had Case-Shiller reports confirming that the housing market is still hot. Prices rose almost 1% compared to last month. Earnings came in before the bell from Best Buy, Big Lots and Smuckers. All of them were trading higher this morning as analysts were impressed with some aspect of their reports.
And 3M stock is up following news of its $6 billion settlement. The company announcing today it's going to pay 260,000 veterans alleging earplugs made by them caused hearing loss. 3M will make the payments starting this year through 2029. This comes just 2 months after the company reached a tentative settlement over claims that so-called forever chemicals contaminated public drinking water. Now, 3M says this agreement is not an admission of liability and the products are safe when used properly.
Also looking at shares of Oracle on the move today after getting an upgrade to buy from UBS. Analysts expect the software company to benefit from artificial intelligence's boom, saying that the stock can jump another 20% as its AI story has, quote, plenty of room to run, Brad.
And Toyota taking a hit today after announcing that they had to halt production in all 14 of its Japanese assembly plants due to a system failure. The automaker now says they are resuming production. The glitch prevented Toyota staff from ordering parts, and the issue is under investigation, but a spokesperson told Reuters that it is likely not a cyber attack.
Well, let's take a look at the housing market. It isn't showing many signs of cooling, even as mortgage rates hit a 22-year high. The Case-Shiller Index showed housing prices continued to rise in June. The National Composite up almost 1% month over month and seeing no change compared to last year. Now, prices have held strong thanks to low existing home inventory. That's been a boon for home builders. Looking at home builder stocks, they're all up over 20% year to date. Luxury builder Toll Brothers said in its latest report that the average price per home in its backlog is $1.75 million. Now that's up from $1.43 million last year. Joining us now is Heidi Patalano, National Mortgage News Editor-in-Chief. So good to see you here, Heidi. We still have this very tight housing market here. Good news for home builders, though, but when do some of these home buyers get a break?
Right, that's a very good question. It seems like there is really no relief in sight for home buyers looking for some price breaks. Definitely, there's an inventory crunch right now, and that is keeping prices high despite the fact that mortgage rates are still inching up. We saw last week that mortgage rates hit 7.23%, the 30-year fixed average, which is just a high not seen in 22 years. And with Federal Reserve Chair Jerome Powell signaling last week that he's open to continuing to raise the federal funds rate, we can expect that rates will stay up that high. But as I'm saying, otherwise, those homeowners who would otherwise list now are not incentivized to do so because the rates are so high, which keeps supply so tight and prices up.
So I was doing a little TI-84 calculator here just before the show, looking at one of the recent reports that came out from a new home builder and Toll Brothers last week, just looking at the year-over-year increase that they're seeing in the backlog of homes that they're still delivering right now, and it came out to about 3.5%. A lot of buyers might look at that and say, okay, well, that is kind of pairing with year-over-year inflation as of right now. But where is it different for some of the home builders and the new home market when it comes to the delivery and that timeline for delivery, especially given that this is one of the more expensive home builders out there? And what does that spell out about the broader housing market, too? If you have a company in Toll Brothers saying that, all right, we still need time to be able to deliver on all of these homes, and we've got significant backlog, and then at the same time we need to write down where there is inventory that is unsold as well.
Yeah, well, it's an interesting question because, we saw that new home sales hit a high last week. And so but yet home builder sentiment is down slightly because the rates, because of the interest rates scaring off some buyers. So we're seeing some of them offer incentives to get people into those homes. They're offering breaks in the customization of the homes that they're going to deliver and in closing costs. So it's an interesting situation because there is that high demand. There may be a backlog that they're still catching up to, but there are certainly buyers for those homes out there.
So Heidi, as we look regionally then, and people are trying to decide, is it better to sort of get an existing home or try and wait for one of these new builds, considering, sometimes the cost can kind of add on as you go in with a new build. How should people be looking at how to decide whether to buy a new build versus some of the limited existing home inventory?
Well, I think it really depends on which market you're in. One thing we're seeing about the home price trends is that they're really varying quite a bit from market to market regionally. So we saw prices go up in certain parts of the country, in the Northeast, for example, but yet in markets like Seattle and San Francisco, we saw prices go down. And also that new home inventory isn't coming up evenly across the market. So, I mean, I think it really depends on where you're at. The other thing that's an interesting part of this is that rental prices for single family homes have sort of slowed in terms of their growth. And so right now that is seeming like an attractive option in terms of staying in a rental and waiting it out for for interest rates to come down.
Heidi, we often talk about how student loan resumption and payment resumption is going to impact small purchases, you know, things from the footwear that you might get all the way to whether or not you're going to buy a new television. But what about for that large purchase that a lot of borrowers are still trying to be able to figure out how they can finance in the future? How does student loan repayments now have a broader impact on that housing market?
Right. Well, that's a very good question. I've heard lots of different opinions on how that's going to play out. I've heard some say that, you know, it's actually already baked in. This, like, underwriters now are still, they've always kind of kept in the student loan as part of the financial picture when assessing a borrower over the past several years, despite you know, the Biden administration's measures with that. But then I've also heard that, you know, psychologically that's a huge burden to these potential buyers, and so that this may in fact scare them off of, you know, thinking it's something that they can do right now.
Heidi Padalano, who is the National Mortgage News Editor-in-Chief, joining us here in studio. Thanks so much, Heidi. Appreciate it.
Thank you.
Definitely. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Inflation has been good for profits. Will disinflation be bad or be good for profits?
So far, we seem to be in a sweet spot where input prices are coming down at the same time that companies are still able to raise prices for their end consumer. Let's see how long that lasts. The question is, are margin expectations realistic for the second half of the year? They're quite high, so it's quite crucial for the earnings outlook in the second half and into 2024. Pricing power is going to be important, meaning it depends on the company.
Best Buy beat on earnings for the second quarter, but joined other retailers with a less than stellar outlook for the year ahead. The company saw sales fall significantly across higher cost categories like appliances and computers, and shoppers under pressure cut back. Best Buy also warning the tech demand would hit a low in 2023. Home Depot and Lowe's saw a similar slowdown in big ticket categories during the second quarter. Target also hit hard by a pullback in discretionary spending. But the value-centric Walmart saw its sales increase in the second quarter on the back of its robust grocery division. So what can we make of the latest retail earnings? Joining us now, we've got Michael Baker of D.A. Davidson, Managing Director and Senior Research Analyst here. Michael, perhaps we put that question to you first. If you are to sum up the retail earnings that we've seen thus far, broad stroke, what would you kind of summarize it as?
Well, the consumer is definitely slowing. We're seeing that across a number of retailers. You just highlighted several. The consumer is spending more on needs rather than wants. And overall, we are seeing, again, a little bit of a slowdown. I will say relative to expectations for some of these names reporting, for instance, Best Buy today, it's not worse than expected. So as it relates to the stock price, that's why we're seeing the stock up a little bit today. But broadly speaking, the consumer is slowing. I don't think that's such a bad thing. It feels a little bit like a soft landing to me. We are seeing a slowdown in spending. Still, the consumer is out there spending because the consumer has a job, but it's more on, again, needs rather than wants, and a little bit less spending than we saw earlier in the year.
And so talk about some of the key themes that have really dominated this retail season. Obviously, when you look at Best Buy, they don't have as broad of an offering as, say, as an Amazon per se. But which of the themes you think really stood out to you?
Well, from a top line perspective, again, it is a slowing consumer. On the margin side, we didn't really hear it much from Best Buy today, but certainly shrink has been a big issue. In fact, Best Buy shrink is actually really well controlled, so that's a positive for them. But overall, we've seen some margin pressure from shrink. On the other hand, supply chain costs are getting better. One thing we're hearing more and more of, and it seems amazing to say it, but is disinflation or even deflation in some cases. Of course, for much of the year, the conversation has been inflation. Now we're seeing a little bit of disinflation and how that actually weighs against sales in some respects, in that you're just getting a little bit less price realization. Now, theoretically, and we think as we get close to the holidays, if we are seeing a little bit of disinflation in some of the core consumable food needs-based categories, that might mean a little bit less crowding out of the wants, and we think it could help holiday sales for some discretionary items. For much of the year, it's been consumer having to wrestle with the inflation in food and then buying less of the wants. That could start to alleviate itself as we look towards the back half of the year.
Yeah, I've seen some of those Best Buy associates shift into a 3-4 NFL defensive formation to control shrink, and they've done pretty good at it. To your point there, Michael. You know, as we think about Best Buy and what was reported this morning, it's particularly interesting as well in some of the categories where consumers are continuing to show that they're either looking for a big discount or waiting for a major sale or promotion to take place. What can you extrapolate from these numbers and apply towards, say, the Labor Day sales, or even further out, some of the holiday shopping season sales? Are we going to see major doorbusters and those deals that consumers have come to expect on a cyclical basis because there's inventory that needs to be moved through, or just because Best Buy is going to have to do something to entice the customers back into the store here for some of the larger ticket items?
Sure. A lot there. So it is a more promotional environment. Absolutely. We are seeing it more promotional. We expect that over the holiday season. It's more because of the second thing you said. It's just to, spur demand and get people to come on in and shop. It's less about inventory. Inventory is actually pretty clean right now, not just for Best Buy, but for a lot of retailers. That was a major issue last year. Most retailers, not all, there's still some pockets of heavy inventory, but most retailers have their inventory well under control. But it is more promotional just to get the consumer to come back in. As it relates to Best Buy, the good news is a lot of it is vendor funded right now, because the vendors have the same incentive that Best Buy has, and that's to get people back in the store. So it is more promotional than last year. It's going to look, this holiday season is going to look a little bit more like it did pre-pandemic, which is those traditional doorbusters and those types of things, those types of calls to action. Best Buy did say something interesting on the call today, and that is that some of their back to school categories are actually doing better than expected. Typically, that bodes well for the holiday season. Back to school leads and points the right direction for holiday sales. And 85% of the time.
And so does that mean that we are to believe in, and is expected now that the worst in the tech demand and that lull is behind us?
It does feel like that. So we're still down year over year. But remember, we were down 10% in the first quarter and then towards the end of last year. This quarter down 6%, and they said in Best Buy is trending at down 5% in August. Still not out of the woods yet, but getting a little bit better. And Best Buy does think it's possible that holiday sales could be closer to flat. So we are trending in the right direction. There were some interesting green shoots that we heard about in talking to the company. Laptop units were actually flat year over year. That's a good sign. TV units are actually up year over year. Gaming was a strong category. So there are definitely some positive signs that we're seeing.
And Michael, as we're seeing consumers continue to trade down or trade off, which of the retailers do you think are best positioned going into the holiday season and beyond, keeping in mind that we are in an interest rate higher for longer environment?
Yeah, well, bigger picture, we think among the best positioned retailers this holiday season is Walmart for sure. They span the spectrum of categories, but when the consumer is trading down, and we are seeing some of that, we think we think Walmart is particularly well positioned in this environment. We think the clubs as well are well positioned. A name like BJ's has added a lot to their general merchandise offering, and we think that could help their holiday seasons. Costco always does well in that kind of trade down environment as well.
And so from an investor perspective here, I mean, when you think about some of the top names in retail that investors should be paying closest attention to, even amid what Corey Berry, the Best Buy CEO, continues to call a very kind of unfamiliar or all too familiar macroeconomic environment with several challenges, who would some of those top picks be?
Well, it's all about expectations and what's already embedded in the stock price. And sometimes the best sales performance doesn't necessarily mean the best stock. But that being said, best ideas, again, Walmart, we think is particularly well positioned here. We like Ulta on the pullback that we've seen. We think that represents good value for a name taking market share. Another name that we highlighted as a best idea earlier in the year and has done particularly well, we haven't really talked about in this conversation, O'Reilly Auto Parts. That space is doing very well. And then the last one we'll throw out is Lowe's. Lowe's has been a particularly good stock this year. For them, it's all about closing the margin gap with Home Depot. And through new management over the last couple of years, they've been able to do that.
It certainly makes sense as people try and, do more at home with their cars and with their homes as well, that those are some of the companies that would also be doing well. A big thank you there to Michael Baker, D.A. Davidson, Managing Director and Senior Research Analyst. Thank you for your time this morning.
Thank you. Pleasure.
All right, we have all your markets actions still ahead. Stay tuned. You're watching Yahoo Finance.
What has been the stock story of 2023?
I would have to say it's AI. I know everyone's saying that, but I would say artificial intelligence dominated Q1 earnings. Certainly when you see the returns, it's been concentrated in a few really mega cap names. But the interesting part of this is on one hand, it's about artificial intelligence, but then it's also about the fact that these are companies with massive free cash flow generation. So part of it is the story about technology, innovation, AI, but then the other part is what's the major theme? If you have positive free cash flow generation, you have that money to fund innovation, you have that money to fund further growth, and that's what the market's going to continue to pay attention to.
Generation Z is rewriting the rules of the internet. Gen Zers, those born between the years 1997 and 2012, are equipped with inherent digital savviness and have been quick to adopt new AI tools, whether it be for work, shopping, or socializing. Now, according to a survey compiled by investment firm Battery Ventures, 28% of Gen Zers are using AI in the workplace today, turning to generative AI more than any other generation. And 53% of Gen Zers will be monthly generative AI users by 2025. So will Gen Z be at the forefront of the AI revolution? Let's bring in Alex Wilhelm, TechCrunch Plus editor-in-chief and co-host of the Equity Podcast, to discuss this. Thank you for joining us so much, Alex. So obviously you have now this massive generation in Gen Z, quick to adopt something that's still growing incredibly at the moment. How are some of these companies responding to this?
Well, I think it's interesting to see that it kind of breaks down into two major components. On one hand, we talk a lot about how AI is finding a place or a home inside of enterprise software, stuff corporations use. And then on the other hand, we think a lot about it in the consumer context, like how Snap has a My AI tool for Gen Z users, for example. So to me, what I'm really surprised about is how this one kind of like new piece of technology is finding a home across both work and home. And for Gen Z to see them be so forward on it isn't a huge surprise to me, because we always think about younger folks being a bit more tech savvy. And so those numbers, I think, are encouraging, but possibly also indicative of where the market will go for everybody, perhaps in a little bit more time.
Is it clear, Alex, and good to see you, Alex, is it clear where Gen Z is willing to take more risk and really embrace new technology to monetize for themselves and create new careers where there weren't careers before, or just to improve their own productivity?
Well, I think it's going to come down in both areas, actually. Sorry to be a little bit boring in my response, but one thing that this Gen Z report did note is that the Gen Z generation is incredibly entrepreneurial. I forget the exact stat, but something like 60% expect to found a business in their lifetime. So if you bring that stat in combination with the fact that they're going to be very heavy generative AI users, you can kind of see where there's going to be quite a lot of grist for that particular mill. Now, where that will manifest, I mean, honestly, Brad and Rochelle, I think the answer is pretty much everywhere. If this AI moment ends up even being half as good as the hype currently says that it might become, I don't think we're going to be able to get away from generative AI. So maybe the question should be, where will it not land versus where will it?
And so then as we look at how Gen Z, especially how they spend online, when you look at this shift we saw from, the sharing economy that came with, millennials and everybody else, but now you have this sort of instant access, but also a priority on services over things. How does that, if you're, say, an advertiser or a company thinking, how do I wrap my head around what Gen Z is looking for right now? What sort of questions do you ask?
I think it's a really good point. Although I'm a little bit perplexed on how everyone's decided that, we, the millennials and so forth, really wanted to rent everything instead of owning it. I wonder if that was more market forces pushing the generation into that. Spotify is great, but I hate having to rent my car, and its technologies. Anyways, when it comes to Gen Z and how they think about things, there's two main components that are standing out to me. One is the combination of social and commerce. I think that's very interesting. To me, that's just not how I shop, but it seems to be the most popular way amongst the generation after me. And then, it's a little bit tough to say, but I do think that ethical consumption is going to be a pretty big deal for Gen Z. And so I think that people who are merely marketing products around price versus how the product is made, how it impacts the world, and how the business behind it approaches culture and the overall marketplace is going to matter a lot more for Gen Z than what we're seeing in and amongst, I would say, other later generations.
Alex, does Gen Z still want the metaverse? Did they ever?
Brad, politely, I don't know how many people really wanted the metaverse to begin with. And I say that as someone who is a long-term AR and VR bull. Frankly, I think it's a cool technology, but it doesn't really have a main draw for it. Certainly some gaming applications, but no one is really going into the metaverse to work. And given the return to work kind of push we've been seeing from corporations, I don't see a real enterprise use for it. So no, I don't think they want it. Though I will say Gen Z and Snap have been relatively forward on augmented reality. So at least that might have some play in the market. But I think the metaverse can be, stuck a fork in. I think it's done.
I mean, in terms of where they are right now, YouTube still, despite the popularity of, your TikToks and your Instagram, why do you think YouTube has such a foothold for Gen Z?
Well, one thing that this battery report talked about was how culture for Gen Z is more fragmented. And that means there's more different cultural niches where people find their kind of digital home, if you will. If you go back 30 years, things like the Grammys and other major award ceremonies were a bigger deal because culture seemed to be more compressed, if you will. And so what I think YouTube does is allow people to pursue their very niche individual interests. And so YouTube has, with its breadth of content and kind of creator marketplace, has a great way to serve everyone kind of what they want. And so if you are Gen Z and you're more focused on what resonates with you versus more broadly, YouTube's kind of an obvious place to go find a home because whatever you want, it already has it and probably quite a lot of it. I mean, just to pick an example, I love a part of the video game world that are about building cities. It's niche and technical and a little bit boring, but if you like that sort of thing, YouTube has creators and videos and series. It's amazingly deep. And so I don't think that TikTok's going to supplant YouTube. I think they'll compete about short form, but anything over a minute, I mean, who does compete with YouTube? The answer is nobody, as far as I can tell.
How does this change the guards at the top of technology right now and some of the companies that have been able to monetize best for and many years now, really engaging with millennials and even some baby boomers and whatever's between baby boomers and millennials. I tend to forget sometimes. I'm sorry to those of you out there. But at the same time, they've been the ones that have been able to try and figure out and fine tune and drive algorithms around engagement. What of them now?
Well, it's a great question. And I don't think it's bad that we always forget that Generation X exists because I don't think they want us to perceive them in general. So we can just leave them to one side. On the big tech point, it's developing is perhaps the best way to go about it. There's quite a lot of parts in the AI world that I think about as it relates to technology, startups, and kind of incumbents. There's large cloud platforms, your Microsofts, your Amazons, your Googles that are powering the back end of this stuff. There's a lot of startups that want to deploy AI tech into the market. And then there's a lot of companies that want to build the models themselves. And so when we think about where the impact will land across the technology corporate landscape, like pertinent to your financial audience, it seems that everyone's kind of got a piece right now. And so when we think about what's going to change in the market and what that will demand from these companies across the AI stack, it's a little bit unclear. But what is clear is that everyone is desperate to not fall behind. And I'm sure you guys talked about Nvidia's earnings report the other day that showed that demand for the kind of the building blocks of this AI technology, the chips themselves, is insanely high because no one wants to get left behind. So to me, we're still kind of in the rat race phase, which is very exciting for us reporters. If I was a shareholder of one particular company, I might be a little worried that I would bet on the wrong horse. But I think it's going to be everywhere all at once, to quote the movie title.
And Alex, I want to ask you, my daughter's 10, she's Gen Alpha, she comes after Gen Z, and she already thinks Gen Z is incredibly cringe, as she thinks I am, just because, I'm her mum. But I mean, in terms of where they get their advice from, especially their financial advice, I mean, you have some very financially savvy Gen Zers, but they're also taking a lot of different advice from different places. What are you looking at in some of these studies in terms of how they're actually managing their finances?
Well, the good news is that according to this battery report, Gen Z's finances appear to be in pretty good shape. Credit scores are high. Of course, we are going to see what happens when student loan repayments comes back onto the market. That could shake things up. But I think we're seeing, once again, a kind of like a splintering of advice. A lot of people talk about book talk on TikTok and how that's influencing the book economy. Well, I think we're probably seeing a very similar thing in the personal finance space. I'm not too concerned about the medium or the mechanism of conveying advice to people, as long as people are paying more attention to their finances. And, when we think about Gen X, millennials, and Gen Z, what have we collectively lived through in the last, couple of decades? A series of booms and busts, effectively. And so I think that this generation, this Gen Z group, let alone Gen Alpha, my daughter's 8 months, by the way, so I don't know if that even puts her in that bucket. I think they're going to have a lot of different places to find information. The only question then becomes, how good is it? And is what's being served up across these various platforms from creators and more established groups, is it actually useful? Thankfully, personal finance isn't that complicated when it comes to savings and whatnot, but more conversation, probably good. But at least Gen Z looks healthy, Rochelle, at this point in time.
All right, Alex, great to have some time with you here today. Thanks so much for joining us here on Yahoo Finance. Alex Wilhelm, TechCrunch Plus editor-in-chief and co-host of the Equity Podcast. Great to see you.
Thanks, y'all. Have a good one.
See ya. Well, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Everybody's been keeping an eye on China, and there's been some very not so good, not so fun type of economic data that's come out of there. There's been lackluster economic data from China compared to the expectations coming into this year. Are we witnessing, as some have kind of leaned back to and called it, are we witnessing the makings of a lost decade for China?
Well, I think the challenge is, really this highlights how out of sync different economies are globally right now. You're really seeing the US in a very different situation than Japan, than China. And you could be right. They've really had a lot of tremendous economic growth. And it also highlights that it takes longer to get out of a difficult period than people really expect.
Key issues between Hollywood writers and studios still linger as the strike heads into its 5th month, with Dune Part 2 being the latest to push back its release date. Our next guest is warning of a $5 billion plus hit to the economy as more delays pile up. Kevin Clouden, who is the Milken Institute Chief Global Strategist, joins us now alongside Yahoo Finance's Alexandra Canal. Kevin, great to have you here with us on this. First, perhaps we kind of start at the top here. When we think about the economic impact here, what is all being factored into that?
Well, the main thing we're really factoring into it is the lost wages. But when we talk about lost wages, we're really not just talking about the salaries and impacts that people are feeling in Hollywood itself, but we're feeling anywhere that filming is taking place across the country and in all the industries and all the small businesses and all the little side elements that combine to actually make what we consider Hollywood possible. That means trailer rentals, that means dry cleaners, that means restaurants, that means catering companies, that means construction, that means trucking, that means all sorts of different factors, and all of them are being affected right now. And even if the concentration is in LA, it's in New York, it's in Atlanta, it's in Albuquerque, it's in Pittsburgh, it's in Chicago, and in a number of different places where filming actually takes place.
So Kevin, I want to focus on that $5 billion projection. Within that, what industry or company, what will be the biggest laggard in dragging down that projection?
Well, the biggest thing that's in it right now is it's no one company. I mean, obviously, the majors factor in more than anything else. So Hollywood's been very heavily concentrated in terms of production activity. So anybody who does film and TV, who does a large number of different productions, so say Disney is a classic example of that, Warner Brothers, Universal. I mean, even at this point, given the role they're playing, Netflix and Amazon increasingly become significant, even Apple. They're all getting affected, but we don't see it as much on their bottom line as we do on the workers, and we see it on the general expenditures. And the reason is that they can put off costs right now. The catch is that, as you were mentioning with Dune Part 2, is that as they delay movies, that means their ability to get the revenue back, to be able to get their expenditures back, becomes harder and harder. And they forego revenues, and they forego any ability to easily snap back out of this strike the longer it goes on.
And obviously, we're at a time right now, Kevin, this is Rochelle, by the way, where obviously 65 years ago when we had a strike like this, you didn't have streaming services, you didn't have, as much reality TV. So how does that really change the landscape of what we might see happen next with these negotiations and how far apart they are?
Well, the big thing that you're dealing with right now that's different than 65 years ago is that the cost of living issue in Hollywood was not a problem 65 years ago. It certainly is now. It is in New York. It is everywhere. And that's a major driving factor, just simply being able to maintain the middle class as opposed to the studio system, which paid people a set amount on a regular basis each month. And people knew what was coming next, and they don't now. And that's the pressure everybody's facing. But the big distinction between now and, say, when the strike happened, the major strike last happened in 1960, is that it's all about where's the revenue coming from next. In 1960, the existential threat had become television. Now it's about streaming. What happens next in terms of where is the streaming money coming from? Because streaming doesn't pay as well, not only for the companies, but for the people working in it, as what we saw with DVD sales, what we saw with broadcast television, and so on.
And Kevin, what behavioral shifts do you think we'll see on the side of the consumer and how that will play in to the studio strategy? For example, we just saw a big resurgence of Suits on Netflix. That's a 12-year-old show. We also got the news that there will be some AMC shows featured on Max. So how do you see that all playing out?
Well, the good news that you're just referring to is that we might break out of what we were seeing in terms of siloing. So there's a real issue where all of these different companies were trying to reconsolidate their content onto their channels and make sure that everybody wanted, if you wanted a legacy HBO or a Warner Brothers produced show or anything, you had to go to Max. Now you could actually go, say, to Netflix, or you might be able to go somewhere else. And that's actually what was making streaming work for a long time. That's what made Netflix work. That's what made a number of different things work. And that's what we call syndication, reselling the shows to other channels and bringing in reviving content that had essentially been neglected. And that was essentially the holy grail that people used to talk about back in the days when Ted Turner made TNT and he made Turner Movie Classics. He did it because he had access to those libraries. And when Netflix bought years ago the rights to all the Twilight Zone episodes, it was this big deal that they were sharing them nationally as opposed to the fracturing that had happened before, or what they did with Friends. So hopefully we will see more of that, and we'll see more content that people actually really want, but had been diminished or they weren't sure where it was, coming back to the fore.
Are we barreling towards a reality of just reality TV? And without the writers having a deal, just us being forced to succumb to or having to, for some people, just watch episodes of Love is Blind or all of these other reality series that have tend to arise in the past when you do have any type of strike like this?
Well, you're definitely referring back to what happened in 2007, 2008. And at that point, reality definitely was an issue. But the difference is the networks were a much bigger deal for what everybody watched. And reality television taking over again, Well, the networks kind of realize the limits, but the networks also just aren't as significant to the studios or to anybody else. It's streaming is a much bigger deal, all the other channels, all the other options. So yeah, I think there is a specter of reality, but at the same time, for a lot of the streaming channels, they don't have to do that. They can go back to old content, or even what Netflix did during the pandemic, where they suddenly brought in a bunch of Korean and French shows and international content, and that's a possibility as well.
Kevin, you were just talking about syndication. Do you think these strikes will speed up the process of media consolidation that's long been talked about?
Well, I think yes and no, because I think there's some consolidation, but it may be happening more on the mid-level. The issue really with consolidation happening on the larger company side is that to some extent we sort of hit the limits in terms of how things work functionally. You know, you had the shifting around where Fox sold what is 20th Century Productions to Disney. You've had a certain number of movements, but AT&T tried to build this giant integrated conglomerate and backed away. That's one of the reasons that Warner Brothers Discovery exists right now. But the distinction is that there's only so much consolidation that can really happen and still be effective and efficient. And when CBS and Paramount combined, that was just recombining. That was a split that was done that people then went back and looked and said, this didn't really work. Let's recombine them again. I think you'll see more on the mid-size where companies look at it and say their financials are under pressure, and you might see more acquisitions that way rather than at the large cap size.
I do appreciate you joining us with your insights. Kevin Clouden there, Milken Institute Chief Global Strategist, and our very own Ali Canal as well. Thank you both so much. All right, taking a look at some big moves in the world of Bitcoin this morning. A federal appeals court says the SEC must review Grayscale's bid to convert its Bitcoin trust into an ETF. The trust issuer manages the world's largest cryptocurrency fund and first applied for the conversion back in October of 2021. Now, the decision looks like it could pave the way for a Bitcoin ETF. It comes after a swath of big institutional players like BlackRock filed applications for their own ETFs. Now, this would be an interesting one as we watch how this could pave the way, because at first this morning, Bitcoin was under pressure, ticking up, though, at least certainly on that announcement so far, Brad.
Yeah, and it was under pressure for a very good reason, low volume. And for Bitcoin hitting one of the lower volume points over the past 4 years here, it's interesting that now this infusion or this fervor around potentially seeing a first Bitcoin ETF finally get approved. It does still come back to the SEC, but at least this in the courts is a good way forward or a good step forward here. And you're seeing Bitcoin prices react positively, as well as Ether, Litecoin, Binance, Dogecoin, and some of the other cryptos as well, closely watched here. Well, Rochelle Akufa and I have another hour for you, the bonus hour, coming up next.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Brad Smith. Here's a look at what we're watching this morning. Big news for Bitcoin. A federal appeals court says the SEC must review Grayscale's bid to convert its Bitcoin trust into an ETF. We're across that story this hour. And the Biden administration unveils the list of 10 prescription drugs up for price haggling between drug makers and Medicare. We'll bring you that key conversation as well. Plus, tropical storm Idalia has strengthened into a hurricane as it churns towards Florida's Gulf Coast. We speak with the former head of FEMA on the response required. But first, let's check in on the major indices an hour and a half into the trading day. As you mentioned there, some of those prescription drugs, some of that news weighing on the Dow a little bit, so it has pared back some of those gains from this morning. Health and energy, some of the laggards this morning. We're seeing the Dow, though, still up, though, about 75 points. The S&P 500 there, also paring back some gains, but still up about 30 points, or 0.7%. Communications leading the way, energy and consumer staples, the laggards there. And the Nasdaq, though, seeing gains of more than 160 points, up about 1.25%. Tesla, Alphabet, and Nvidia leading that charge. Let's also check in on the Treasury market, especially after we got that JOLTS data this morning. We're looking at the 5-year down about almost 2.5% there, and taking a look at the 10-year pulling back significantly, still above that key 4% level, but as you can see, down about almost 1.5% on the day, and the longer-term 30-year yields also down about 0.9%. Well, Brad?
JOLTS edged lower in July, but with the big jobs day release on Friday, how important is this data? Joining us now with the answer is Yahoo Finance reporter Josh Schaefer here in studio with some fancy numbers on the screen there, Josh.
Yeah, Brad, so this is the report that we got out about an hour ago now. It's the July job openings and labor turnover survey. And so what you're looking at is 8.8 million openings, 5.8 million hires, and 5.5 separations. And I want to take a look at what that looks like in a graph, because this is what Federal Reserve Chair Jerome Powell talks about a lot. He talks about the labor market getting to a better balance and us seeing a better balance between supply and demand. Well, when we talk about demand, we're talking about job openings. Just took a big tick down in July. This is now the lowest level we have seen July openings at, or job openings at, in more than 2 years. Then when you take a look at hires, also came down to the lowest level since January 2021. But really what you want to focus on here is the spread. That is what Chair Powell is talking about, the difference between the purple and the blue. The purple and the blue, back when things were a little bit normal before the pandemic, used to be just about in line. Now we've had this big gap. We're waiting for it to come closer. Only one reading today, but you see we're getting a little bit closer as that purple line comes down from being significantly higher. One other graph I want to take a look at from the JOLTS report today is the quits rate. This is something you're going to hear a lot about when we talk about recessions, and if we are ever going to go into this recession that I've been standing here at this board talking about for it feels like over a year now. What you see here on this graph is today's quits rate came in at 2.3%. Its lowest level in, again, about 2 years. But what you're looking at in the shades is when we've seen recessions. We see the quits rate come down significantly as we enter or leave a recession because people feel less confident about their jobs. The economy's tighter, so people start quitting. So we're seeing that number come down significantly right now, and that will be a number that people watch moving in the months forward as we continue this recession conversation. Does that quits rate go down further and further so people want to stay in their jobs because they are uncertain about the economy? That will be a big question. But overall, Brad, takeaway from the JOLTS report today, we got the Nasdaq up over 1%. People feel like they might have a better sense of where the Fed is at, it seems like, with those interest rates. And maybe they stay steady instead of hiking one more time.
All right, good analysis. A lot to extrapolate from that report that dropped 10 a.m. today. Thanks so much, Josh. Rochelle?
Well, as we continue that conversation, job openings edged lower in July, showing that there may be some cooling in that hot job market ahead of Friday's jobs report. Now, the Fed is looking for some relief in the tight labor market as rising wages are helping to keep inflation sticky. Now, stocks popped on the news as investors have priced in a soft landing, hoping inflation can come down without causing a recession. But our next guest isn't so convinced that an economic slowdown can be avoided. Joining us now is Eddie Gabor, Key Advisors Wealth Management CEO and co-founder. Good to see you, Eddie. So you say that there's no way we can get to this 2% inflation target by next year without a recession. Break down your base case for us.
So look, in my opinion, when you look at the percentage basis, you have to drop to get down to 2%. In our opinion, the only way you can get there is by demand destruction. I think the Fed obviously knows that. Now look, if they ultimately change and kind of flinch and say, well, 2.5% or 3% they can live with, that completely changes our opinion in regards to a recession. But again, I don't see how you can get that rate of change to drop that much by next year without a recession. So right now, we think the consumer is showing some weakness. When you look at credit card debt, then you have student loan payments having to start back up in October. So I just don't see it. I hope I'm wrong and we don't have a recession. But one thing I am convinced of is the market is not priced for a recession. And if we are correct in our assessments, it could bring quite a bit of volatility. And lastly, look, the JOLTS numbers causing some reprieve in the bond market today, but we're concerned that we're going to see a reacceleration of inflation when you look at oil prices going up back into the 80s. So we're not out of the woods yet with this fight with inflation. And so I think the bond market's going to continue to be very volatile as we get these mixed signals.
Yeah, it seems like the markets are priced for AI improving productivity and perhaps the Eagles winning the Super Bowl this year. But Eddie, as we think about more broadly going forward, this potential recession that you're calling for, are we talking about a shallow recession or one that's more mild from your projections?
So whether it's mild or shallow, I think the market, when you look back at history, whether it's mild or shallow, it's not good for the equity markets. You normally will see a double-digit drop in regards to the markets from the levels where they are when the market finally prices in the recession. And that is really our base case, if that's still in the cards. Now, look, without question, the market and the economy has been much more resilient than what we anticipated coming into this year. So it may be a story for the first half of next year. But again, when you follow the rate of change here and you're looking at the direction where the consumer's going, being in a consumer-driven economy, things aren't heading in the right direction. They are decelerating.
And we certainly keep hearing some of these warning signals in what we heard from some of these earnings calls and some of the forward guidance that they were looking at, sort of teetering on the edge of how the consumer is faring right now. And when you couple that with, as you mentioned, student loan repayments, credit card debt reaching some of these record highs that are also causing some concern here, when do we see that start to show up more significantly in earnings?
So I think you'll see that in the fourth quarter of this year is when you'll really start to see that. And again, if I had to pinpoint a time period where you'd start to see that weakness recognized in the market, that's probably when you'll see it. So we'll still get some rips and rallies and then some dips and maybe sideways. But I think in the fourth quarter is when we're going to start to really see that. And look, real estate is going to show some cracks as well, too. You have mortgage rates at over 7%. You're going to have a problem in the regards to those folks that have mortgages at 4%, 3% right now. I don't think you're going to see them putting their house on the market to sell anytime soon.
What's your top trade if we do see a recession?
Would be buying the long end of the Treasury curve, because if we see a recession, you're going to see the long end really drop, in our opinion, and that's going to be where you'll get that initial pop, and then you'll want to rotate into your higher beta plays. Right now, we're heavy into money markets, frankly, because of the yield that they're having, because we're still not convinced that the volatility in the Treasury market's over yet. But once that gets priced in, you should see the long end of the curve really come down.
And Eddie, what are some of the key questions that some of your clients are asking about the environment that they're in and how to play that right now?
So the biggest question we're getting from our clients, because our clients, many of them are retired, so this isn't their first rodeo, is they see what's happening under the hood economically with their businesses, where they live, and their local economies, and they're scratching their head as to why the market this year has ignored those fundamentals. So the disconnect between the fundamentals and the market is the number one question that we're getting right now. So we continue to talk about patience, and patience is one of the hardest things to have as an investor. But with short-term yields paying what they are, it makes being patient a lot easier today.
For companies that we've continued to monitor over the course of the earnings season, many of them citing macroeconomic challenges and how it could impact their company. But I think more broadly, for anybody who's looking around the world at where they're also being impacted, not just by the U.S. and the domestic front, but also the global situation. Are there pockets of this market that you could see turning earlier because of their exposure internationally, particularly here, Eddie?
So it's interesting you bring that up. We are bullish on India. That's our top equity position that we have, frankly. Because of the weakness in China, we believe that India is going to be the winner due to that. And I think you're going to see more and more companies invest in India and less in China. So India's economy looks like it's going to be accelerating over the coming quarters because of that dynamic. So it's not, so there are pockets, in our opinion, where you can make money in this environment again, but we think we are here domestically have some challenges. So we're being more cautious on the domestic front.
And as you said, they're easy to be at least patient at this point when you're looking at some of these yields. Always great to see you, Eddie Gabor, Key Advisors Wealth Management CEO and co-founder. Take care.
Thank you.
All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
What are investors too worried about?
In some respects, the economy. In other words, low-end wages are killing it. Consumers doing great, and they've been sitting there fretting over the economy and not worried about asset prices.
This morning, Medicare unveiled the first round of prescription drugs up for price negotiations. The announcement marking a major step forward in the decades-long push to lower drug prices. Anjali Kamlani spoke with the director of the Center for Medicare earlier today. Here's some of that interview now.
Today, we released the 10 drugs that have been selected for negotiation. The next step is on October 1st. The manufacturers can decide whether they want to participate in the negotiation process. October 2nd is when we will get data that we will use for this negotiation. We will then engage, have patient-focused listening sessions for each of the 10 drugs, meet with each of the manufacturers, and then enter the negotiation process with an initial offer. All of this is laid out in the Inflation Reduction Act law and in the guidance that we put out. So on February 1st, we will put out our initial offer to the manufacturers. According to the Inflation Reduction Act law, they have about 30 days to provide a counteroffer if they do not agree with that offer, or to accept that initial offer. If with the counteroffer that CMS doesn't agree, then we will engage in up to 3 negotiation meetings for that back and forth, ultimately leading to a final agreed maximum fair price that will be published on September 1st, 2024. And we will also then subsequently publish a narrative about that entire negotiation process.
I know that some of the companies have already filed suit trying to delay or stop the process altogether. And in their lawsuits, some have said that they're worried about what that maximum fair price is going to be and that it could, quote, be as low as a penny. And so I wonder what your thoughts are on that, and how, if you could explain how Medicare is going about deciding what the bar is for an appropriate cost.
Yes, I think we all have shared goals that we want to improve access and affordability for the innovative therapies that people need. And as we laid out in our negotiation guidance, we want to be able to look at the benefits that a drug brings to populations. Does it address an unmet need? Does it address different populations that have needs? Can we look at things like being able to live at home and not be hospitalized, and to be able to incorporate all of that into an agreed upon fair price for the Medicare program for all of the people who rely on these often life-saving medications, and for the American taxpayer. And so that is how we will approach this in a true back and forth negotiation process.
I know some of the drugs that were listed caught some by surprise. Some expected, like Eliquis, but then Stelara, I know a couple of reporters have already asked about the fact that they may be facing generic competition, as well as the insulin, because of that out-of-pocket cap already in place. Can you explain why some of these drugs made it, and whether or not the list could potentially change before 2026?
The list of drugs that have been selected will not change. Those are the selected drugs. How we came to that selection was following the new drug law, what is written in the law, where first we looked at the 7,500 drugs that are covered in the Part D Medicare program, and looked at which ones are what are called in the law qualifying single source drugs, meaning that they are drugs that have been on the market for 7 years for a drug product, 11 years for a biological product, and do not have competition. From there, again, following what is in the law, we excluded drugs with low Medicare spend, plasma-derived products, certain orphan drugs. We also got information from manufacturers for a small biotech exemption. Again, that is laid out in the law. And then also looked at whether for biosimilar manufacturers, they could submit a request to us for a potential delay if there's a biosimilar coming on the market. Again, that is laid out in the law, and all of this is also put in detail in the guidance that we put out. Once we went through all of these criteria, we ranked and basically have the top 10 drugs in highest gross spend. So all of the drugs that are listed are ones that met all of those criteria.
Now tell me about these companies that were selected. I know that, the administration chose to release this list before the opening bell, and it hasn't really seemed to make an impact on the stocks right now. Do you see that as a sign that they are not really going to be impacted negatively by these negotiations?
I think we know that the pharmaceutical industry is strong and thriving and innovates and will continue to innovate. And in fact, the way that we have laid out, as we were talking about, Anjali, this negotiation process, it really is with an eye towards how do we reward the innovations for the cures and therapies that people need? How can we incorporate real world evidence for these drugs that have been out there being utilized to understand what impact they have in the real world for real people, so that we can take that into consideration as we look at what a price should be for these kinds of medications? And I think that's what you're seeing.
And I know that the fines are going to be put in place for those companies that decide not to participate or who don't want to participate in the negotiation process. What then happens with this list, and what happens to those companies? Is it, a fine in perpetuity, or is there an end-point?
Yeah, so there is an excise tax that is operated by the Treasury Department, by the IRS. If a company decides not to participate, in the negotiation process as you described, we laid out in the guidance where, if there are ways that a company cannot have that excise tax, where they can, negotiate and come to an agreed upon maximum fair price, or they can exit the Medicare and Medicaid market. And the details of that are in the guidance.
That was Anjali Khemlani there, speaking with the director of the Center for Medicare. I will stay with us. We have all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
What's your coffee order? I don't know.
My coffee order is really boring because I only drink black coffee. So I just took advantage of your espresso downstairs, and I had a basic espresso.
Nice.
Very, very dull.
August, a lousy month for investors, but maybe even worse for parents. Yes, you guessed it, the dreaded return of back-to-school shopping. Now, as a parent, I know the stress of getting my kid ready for the new school year. I mean, you're dusting off the backpacks, you're collecting all the thousands of school supplies, buying new clothes, and then scheduling these checkups. All of it can be a pain, but here are my least favorite things about back-to-school shopping. First of all, more expensive items, not just when you factor in inflation. I mean, the National Retail Federation is saying the average household is going to spend about $900 just on back to school spending this year. And overall, $41.5 billion. That's a record high. So we're already pinching our pennies and now everything's even more expensive. I mean, you have to buy things like laptops, which we didn't have to buy how many years ago. So all this high tech is really hitting our pockets. Second, I want to get to some of these brand specific items. It's not just, oh, you know, buy this set of crayons or whatever it used to be. No, it has to be these specific Crayola ones. It has to be this specific Chromebook. And this is not cheap. You know, I love brand loyalty as much as the next person. But when I'm trying to like price compare and price shop, that is not helpful to me. That hurts. It hurts my soul. And I already hate shopping in person. Now, the third thing is these multiple visits to multiple stores. Some things you just cannot get. One of the things on my daughter's back to school list was a meter length ruler. Where am I supposed to find that? Because there's a shopping list for the stuff at school, and then there's the shopping list they gave me for the stuff at home. So it's two sets of things that I need on top of everything else. She needs, you know, her clothes from here, her uniform has to be from, you know, Tommy Hilfiger or Land's End. I was like, what happens to just getting the basics, the simple things, especially at a time like this? So parents, I feel you, my soul hurts as well, running up our gas, trying to go here, there and everywhere, but we're all in this together and at least, you know, they'll be in school, so we'll have a little bit of free time. Well, now, despite those inflationary pressures, American shoppers do intend to spend more on back-to-school supplies this year than last year. Now, that's according to a new survey conducted by Jefferies. Let's bring in one of the authors behind the study, Corey Tarlow, Jefferies Vice President of Equity Research. Good to see you here, Corey. So for some of us parents out here, we're really feeling the pain here. Why is everything so much more expensive, and where are we seeing the biggest markup this year?
Great. Well, thank you for having me. I think that the reason that things are so much more expensive is clear and it's inflation. According to the survey that we did, we conducted a survey of 600 consumers in the US. And what we found that was interesting is that 50% of the people who we surveyed actually intend to spend more into back to school. But clicking a little deeper, 70% actually cited inflation as the primary reason that they're spending more. And as you click down by category, interestingly enough, apparel was one category where people are not only planning to spend more, but also even perhaps buy more units. So 50% of people plan to spend more in dollars on apparel. And again, that's because of inflation. And then 30% of people plan to buy more units in this category.
See, Corey, Rochelle is better than me because I would finna be right next to my student, right next to my kid in class if I'm spending all this money. I'm getting the education too. I'm brushing up on some of that stuff. I'm spending all that just for back to school. But, you know, all of this spending considered, what does this really tell us or forecast about the rest of the year? Because it's making it through back to school, but also making it to the holiday season that many consumers might also be thinking about. And that credit card debt is starting to rack up a little bit more.
Yeah, I'm glad you brought that up. So we have seen a consumer that's overall a little bit more resilient than what we expected, but we are seeing credit card debt continue to pile on for many consumers in the U.S. And so as a result of that, and the survey data that we conducted actually showed this, is that private label is becoming an increasing area of focus. And you mentioned that buying many branded items can be a pain point for you. Well, store branded items, particularly private label at a retailer like Walmart, are really resonating strongly with a lot of consumers in the US. And so our survey data indicated that 77% of respondents are actually likely to spend more on store brand items. And so as I think about a retailer that could benefit from this, it's Walmart, because Walmart has, at least in the US, a private label business that's over 20% of sales. And that's a $400 billion enterprise in the US that, again, is over 20% private label. So that's $80 billion in private label sales. And that's one thing that I expect that well positions Walmart not only into back to school, but into holiday as well.
And what about the companies who used to benefit from this? Obviously, they're losing some market share now to the Walmarts of the world. Who's then falling off then if Walmart is now picking up the benefit of this?
Well, I think Walmart's definitely taking a lot of share from many players in the retail space, whether it's traditional grocers or other mass players, or even some convenience stores. So it's definitely a business that is gaining a lot of share, not only online, but also in stores. So far, at least quarter to date, we've seen Walmart comp up in the mid-single digits based on where they've guided. And then Target is comping down in discretionary categories in the low double digit to mid-teens in categories like home or apparel and hardlines. So there may be some continued underperformance in that category ahead at Target, and perhaps a little bit of better performance at Walmart ahead.
Corey, in the numbers that we got from Best Buy earlier today, we heard from CEO Corey Berry saying and kind of signaling that this might be the bottoming out in terms of this lull or this pullback in demand for some of these electronics, for some of the broader tech that consumers have in their hands or on the walls in their homes. Do you believe that to be true?
I don't cover Best Buy, but perhaps. I mean, we have seen so far year to date a relative weakness in bigger ticket items at some of the largest retailers like Costco and Walmart, even Target too. So far, I think that that's continued, but it sounds like there's been some encouraging commentary on it. At least, perhaps maybe it's getting a little bit marginally better. But I still think that with the impending resumption of student loans, that some of these discretionary categories may continue to be challenged.
And Corey, as we look at some of the seasonal spending, obviously you have back to school, there'll be Labor Day sales, holiday shopping as well. How should investors position themselves then to take advantage of, obviously the pain of the consumer, but perhaps where could investors at least benefit in this environment?
Well, one area that we think, or one company that we think is very well positioned, as I mentioned, is Walmart. And it's really not only the reasons I cited, but also the fact that into back to school, according to the data that we had, Walmart was a top destination, even more so than Amazon in some key categories like office and school supplies, apparel and electronics, and even accessories too. So based on the data that we saw, it was something like 55% of people plan to spend more at Walmart in office and school supplies. 41% are planning to spend more in apparel and accessories, and 39% are planning to spend more on electronics. So category wide, it's a business that is well positioned. And then also, as you look at channel, so not only in stores, but also online, what's interesting to me is that the data indicated that around 40% of people are willing to buy their back to school spending or back to school goods online. And Walmart has an $80 billion global e-commerce business that's growing over 20%, on track to do $100 billion in sales and even more than that in the coming years. So that's a business that we think is very well positioned ahead.
Corey, great analysis as always, and great to have you on here with us. Thanks for taking the time.
Thank you.
All right, guys, some big moves in the world of Bitcoin this morning. A federal appeals court says the SEC must review Grayscale's bid to convert its Bitcoin trust into an ETF. The trust issuer manages the world's largest cryptocurrency fund and first applied for the conversion back in October of 2021. Let's break it down with Yahoo Finance's Alexis Keenan and David Hollerith. And Alexis, I want to go to you first on this. What do we know about how this has played out so far in the courts, and what does this signal next?
Yeah, so this decision, it's coming from an appellate court, so a very high court just under the Supreme Court in DC. And what this court is saying is that the SEC has to go back and review its rejection of this spot ETF. Now, the SEC has already approved several futures ETFs for Bitcoin, but hasn't done so in this capacity. So it's saying that this decision that the SEC made, that it was arbitrary and capricious. And when the court says that, what they mean is that the agency has abused its discretion, right? That it could have come out another way. So it wants the SEC to go back and take a look at this. So today, a win for Grayscale, getting a reconsideration of this effort that it's been making for this conversion.
Wow.
And David, I want to bring you in here in terms of the reaction from the Bitcoin community and even the movement that we've seen in the Bitcoin price so far this morning. What are your big takeaways?
I mean, yeah, I think if you look at the Bitcoin chart right now, it's risen. It's about 4%, up 4% on the day. But in the last hour, sort of after the court decision, it rose 5%. So, really what we're seeing is generally investors in the industry are taking this in stride. For a little bit larger context, this is a different issue than some of the other things that the industry is dealing with, the SEC. But there's been sort of a clash between crypto businesses and the federal securities regulator. And so anything like this is sort of, at least in terms of sentiment, is sort of investors seeing it as a win against the regulator and sort of offering them more room to sort of have crypto products, Bitcoin ETFs, or even just the listing of other crypto assets as approved in the US for investors. So it's a big win.
And David, before, obviously, we know that any sort of good news will usually send Bitcoin up. But if you had to sort of temper expectations as to sort of what happens next and what people should really make of this, obviously this is just one step in this. What would the takeaway be there?
Yeah, absolutely. So I think first, I think it's fair to point out that it's hard to understand what the SEC can do at this point, given that sort of their argument has been rejected. They will have to come up with some new argument for why they cannot approve a Bitcoin spot ETF, or in this case, convert the Grayscale Bitcoin Trust into an ETF. But that being said, even the SEC has been more amenable to listing Ether future products, which are sort of another topic going on. So it seems to me like this, to temper expectations, this all takes more time. And this is not like a clear approval, but it does up chances for a Bitcoin spot ETF. And I think, some of the excitement about that, it's hard to judge what a product like that would mean for investors. But we do know with the futures, the Bitcoin futures listings in 2021, it sort of corresponded with a large rally for the asset class.
And Alexis, there were a lot of other companies that were looking to kind of push this forward, at least this court ruling. What do we know about the companies that stand to benefit? Even as we were showing our viewers, some of the companies that are already seeing a price reaction in their stock, there were some big names that were also pushing for this ETF to move forward too.
Yeah, I think Bitwise was one of them that was involved in this, and there are others. But look, as David said, this will take some time. Mm-hmm. This will have to go through a complete review, and whether or not eventually it will be ripe for even the Supreme Court, we'll have to see.
Absolutely. All right, we're taking a look at shares of some of those companies that would be big beneficiaries supposedly here, and we'll see exactly how this plays out continuously. Thanks so much. Michelle?
Appreciate that team coverage there, Alexis Keenan and Dave Hollerith there for us. Well, shifting gears now, Tropical Storm Idalia has strengthened into a hurricane as it churns toward Florida's Gulf Coast. It's set to make landfall in the Big Bend region, bringing with it winds of 75 miles per hour and the threat of flash floods. As you can see from some of the imaging there, around 14 million Florida residents are currently under hurricane and tropical storm warnings. Yesterday, FEMA announced nearly $3 billion in funding for communities to build resiliency against climate change-fueled extreme weather. Joining us now is Craig Fugate, former FEMA administrator. He led the agency through multiple disasters and oversaw the federal government's response to major events such as Hurricane Sandy, Hurricane Matthew, and the 2016 Louisiana flooding as well. We do appreciate you joining us this morning here. In terms of the preparedness that you're seeing at the moment, what should be at the top of people's list when they see warnings like this coming up?
Well, the people that live along the coast need to move to higher ground. We use a lot of terms that kind of sanitize what's happening when we talk about, storm surge. The way people drown in these storms or die is they drown, or it's blunt trauma for cars and boats washing through their homes. So the critical thing right now is for people in the coastal areas to heed the evacuation orders, move to higher ground. They still got time. For everybody else, it's getting ready for a lot of wind and water. Power outages will probably be measured in days or weeks if the storm comes through as forecasted. So again, for people in the coastal areas and evacuation zones, now's the time to move to higher ground. For the folks that are not in the evacuation zones, is to prepare for the impacts most notably is going to be high wind and power outages after the storm, but also isolated tornadoes and heavy rainfall.
How is the funding dispersed? Where are the areas that FEMA would typically look to kind of go down the list of prioritization?
Well, when you're talking about these dollars the administration announced for building climate resilience, these are programs that FEMA has run before, but now with more emphasis on building resiliency from future impacts. And it's things that will go out to deal with things like flood risk, looking at how to address heat islands that are occurring in urban areas, how to harden infrastructure so it's more resilient before the next storm. So all of these things are projects across the nation. We're talking about the hurricanes now here in Florida, but we're not the only area. Wildfires in California, extreme rainfall events across the country, tornadoes, other things. But look at the heat dome that's been sitting over central U.S. So all of these things across the nation would be things that FEMA would be considering as the states make the request.
And Craig, this is coming at a time when we do have multiple extreme events, and you're seeing insurers pulling back, saying that they're not going to, take on new customers now because the cost is just too high. What can people then really do to protect themselves or protect their belongings and their livelihoods as insurers pull back?
Well, this is the challenge we're seeing, that we're running into risks that are becoming uninsurable. And for the insurance industry, not selling insurance means they can't make money, but they can't sell it and lose money. And so I think for a lot of people, it's unfortunate. We're having to make decisions about, buying insurance at very high rates if it is available, or going without insurance. And that's going to put a lot of homeowners, particularly those that most of their equities in their homes, at tremendous risk, because nobody's coming in to bail them out without having insurance. So the federal government doesn't provide that kind of assistance after a disaster.
This has been one of, if not the hottest year on record, Craig. And so with that in mind, companies, individuals, households are trying to wrap their minds around what a future where climate change drives more adverse weather events means for the economy, how this shifts even where people live at. And so for all of these considerations, for the heat dome that we've seen this year, as you mentioned, what type of economic impact are we really having to grapple with at this point?
Well, we'll still be adding up cost. I think when you think about heat waves, one of the things we know is it's one of the deadliest of all of the hazards we face from weather. But it also has significant economic cost as energy bills go up, productivity goes down, disruptions in supply chains, impacts to agriculture, especially things like flash droughts. And the fact we're in a global economy where it's not just here in the U.S. that are being impacted. So I think if you think about it, we've basically built our economies around the last 100 years worth of stable weather patterns. And now as they become more extreme, we're not going to adjust to them overnight. So there's, again, the administration, $3 billion, I'd say that's a good start. But I think for a lot of industries, for a lot of communities, and for individuals, it's going to be a major adjustment with very little time. And we're going to continue to see these losses increase until we get to the point where we are adapting faster than the climate has changed. And that's the thing. The climate has already changed. The question is, how much worse can it get?
And so, Craig, for people watching this who are wondering what should be in my preparedness kit when you do have something like a hurricane or floods coming towards you, what are the top things that people should have in a preparedness kit?
If you live on the coast, a go kit, you and your pets leave, move to higher ground. If you're not in the evacuation zones, then you need to look at whether you should stay where you're at or evacuate. If you're staying, and that's what we recommend for most people, you need to be prepared for extended power outages, disruptions to your waters, not being able to go get medication or go to the store. So you need to have enough supplies to carry you for several days. In fact, as we're seeing increasingly, up to a week is not uncommon for disruptions to the supply chains before they can start back. So those are the things you need to be thinking about. But before the storms threaten, before the fires threaten, do an insurance checkup and make sure you have proper coverage. And here's one I'm going to plug over and over again. Get flood insurance. I don't care if anybody's told you don't live in a flood zone. We're seeing too many extreme rainfall events, and it is the fastest growing risk we're seeing is the uninsured risk without flood insurance, homeowner policies will not cover rising waters. You have to have a separate policy. And this is something FEMA's tracking. More and more areas are flooding where people have very low rates of flood insurance, usually less than 5% in most areas outside of the traditional flooding areas. And that means you're putting your financial recovery at risk by not having flood insurance.
Craig Fugate, former FEMA administrator, joining us here on Yahoo Finance. Craig, thanks so much for the timely insights here and the word of warning as well and caution. Appreciate it.
Thank you.
Thanks. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Have you tried Threads yet?
I have not. No, I have not. I hear good things though, so I'll leave it at that.
Okay, it's early days. I know I was in the tens of millions that first signed up for it, so I guess that's all I have going for me right now.
Well, if you're an active user, then you can coach me on it.
Okay, I will report back on that.
Smucker reporting some mixed results for its first quarter before the bell. A miss on net sales, but profit beating expectations. The company also boosted its profit guidance for the full year as higher prices on its peanut butter and jelly offset rising costs. Joining us now on these results and more is Mark Smucker, JM Smucker Company CEO. Appreciate you joining us this morning here. So break down the results for us here. Obviously, we saw some strength in that peanut butter market. How surprising was that?
You know, actually, Rochelle, we had great results, and we did actually meet expectations on the top and bottom line and actually raise our guidance both for gross profit and our EPS. So results were strong across every one of our categories. That would be coffee, and our pet foods, pet snacks, as well as our spreads and Uncrustables business. We had fantastic results, both growing sales as well as our volume. So great quarter for us.
Mark, I'm glad you said that Uncrustables business. It's my favorite part of the business. It's easy. You just throw it in your bag, you pick one out later, and then you're good to consume. But at the end of the day, when you think about how this continues to kind of be a core staple in the broader lineup of Smucker's products out there, what is the next Uncrustables moment? What is that next product innovation that the team is zeroing in on to try and drive another type of product that has the same type of fanfare than Uncrustables has had?
Yeah, Uncrustables is on fire. You know, we're going to hit $800 million in sales this year. We're building our third plant, and we're still in growth mode, even on core peanut butter and jelly. Obviously, we offer peanut butter and honey, peanut butter only. We have a chocolate hazelnut execution. And in the future, we will launch more products in that same format. We're thinking about meat and cheese, egg and cheese. That would be a couple years down the road, but it will be supported by this third plant we're building in Alabama. So lots of growth to come.
And Mark, we have to talk coffee here because, I mean, that portfolio continuing to do well. You know, a lot of consumers, they're discerning, they're trying to see, you know, maybe I should make more coffee at home, look at some other options here. How is that market playing out, especially when you look at the cost of food inflation?
Yeah, great question. Actually, our roast and ground business has been strong this quarter. We have seen a little bit of cost relief, which we've passed along to consumers by sharpening prices. But we just launched cold brew under the Dunkin' brand, and consumers are customizing, making their own often cold coffee drinks at home these days. And so that concentrated, already brewed coffee plays into them making those coffee cocktails in the morning at home.
Mark, you can have jelly or jam at any time of the day, but what you just said is particularly striking here, in that it might give our viewers a sense that you want to play more in breakfast when you're talking about an egg and cheese potential. Is that something that you're looking to do more of, playing more in breakfast and at the start of the day?
Yeah, it's all about occasions, right? And so breakfast is clearly an occasion that our products definitely cater to, whether that's coffee or Uncrustables. And as you point out, potentially in the future, some other iterations on Uncrustables. But yes, breakfast is one of our key occasions. Peanut butter and jelly sandwiches are the #1 sandwich consumed at lunch. So breakfast and lunch are big for us.
I mean, certainly getting ready for back to school, packing these school lunches, you want that quick go-to, that PB&J. Talk about the back to school influx that you're seeing, especially as parents prepare. I mean, some parents are still going to be loyal to their brands. You know, kids are very picky, especially. How much does that help when you're looking at the back to school market?
Well, back to school is a key period for us, right? And our brands perform very well during this time period. And of course, PB&J, as we just discussed, is key in that. Our business has continued to grow in schools. You know, we're selling Uncrustables in schools. We're selling Uncrustables as well at universities, golf courses, and now convenience stores. So again, that product is really just a really great success story for us.
Mark, the reality right now, too, on the climate front, and something that perhaps you consider as well, is that this is one of the hottest years on record. It's changed farming. It's changed getting the commodities for companies like yourselves and the natural resources to allow you to be able to create a lot of these products, too. You know, how has this shifted the operations over at Smucker and where you kind of envision the future under a climate change challenged world?
You know, our operations are performing well, but we have to continue to be focused on doing the right thing for this planet. And, you know, we recently launched new climate goals. We've been very successful in, reducing emissions, obviously offsetting water, almost zero waste to landfill, and renewable energy. So we really want to do our part. It's really important as a company, that we continue to minimize our footprint, and we will continue to focus there.
And has it changed the way that you source any of the ingredients?
A little bit with coffee. Coffee comes from 40 plus countries. We have invested in initiatives to help find different coffee trees that can perform better at hotter or lower altitudes and without actually introducing new genetics into that. And so there's a nonprofit called World Coffee Research that we helped to fund and continue to support. So that's just one example of ways that we can support more globally some of those climate initiatives.
And Mark, obviously, it's a tough time for a lot of shoppers right now, not to mention you've got student loan repayments set to restart. A lot of shoppers looking to trade off or trade down. How do you keep a competitive edge when, if you're looking at, say, prices inside a Walmart for a different brand or off-brand, or pet food are cheaper? How do you manage the competition there?
Well, I think the most important thing to do for us is to make sure that we're playing in all segments of our category. So if you think about coffee and even Milk-Bone dog biscuits, we have offerings that reach the value consumer all the way to the premium consumer. So we're offering products, whether it's Folgers or Dunkin' as a more premium offering. Consumers have choice, and we're able to meet consumers where they need to be met and make sure that we're offering products that fit their budget and fit their lifestyle.
We do appreciate you taking the time to join us this morning. Mark Smucker, JM Smucker Company CEO, thank you so much.
Thank you.
All right, well, let's get you a final check of the markets as we head into the noon hour. As we see here, looking at all green across the board there, we're seeing the Dow now picking up the pace here, up about 190 points, or about 0.5%. S&P also gaining strongly there, up more than 1%, or 49 points on the day. And also taking a look at the tech-heavy Nasdaq, continuing to thrive here, up about 1.5%, or up over 200 points. Certainly encouraged by that JOLTS data, signaling that the job market is cooling, that perhaps even though we know the Fed didn't talk about any sort of interest rate cuts coming up ahead, perhaps giving them a little more food for thought as we prepare for a lot more jobs data coming out this week with ADP numbers and, of course, the big bumper jobs data coming out on Friday. Well, that does it for now. Brad Smith and I will be back tomorrow morning. We'll see you then.